Okay, good afternoon, everybody. As the AAC designated federal officer, it is my pleasure to call this meeting to order. Before we begin this afternoon's discussion, I would like to turn to Chairman Seelig, the AAC sponsor, for opening remarks.
Good morning, everyone. Thank you for being here today. I'm excited to reconvene the Agriculture Advisory Committee for the first time in over 2 years. Welcome to all our new members, and welcome back to our existing returning members. Now, before I begin, I must note that the views I share today are my own views as chairman and do not necessarily reflect those of the commission. After my confirmation last December, one of my first official acts as chairman was to revive the Agricultural Advisory Committee. It's been a tradition for the chairman of the agency to sponsor the committee since it was first formed by Chairman Susan Phillips in 1985. President Ronald Reagan appointed Dr. Phillips to lead the agency as the first woman to lead any federal agency. At a time when farmers were struggling to recover from a severe drought, exchanges had just begun to list novel commodity options after a long prohibition, and the CFTC and SEC grappled with thorny jurisdictional questions as the once bright line between commodities and securities began to blur. Does any of that sound familiar? At Chairman Phillips' swearing in, President Ronald Reagan remarked that this commission is one of my favorites because it proves that government can do a good job without soaking up the taxpayers' money or over-regulating the marketplace. And it does its job without hindering industry growth and innovation. It's my hope as chairman to ensure that President Reagan's words continue to ring true today and for years to come. That's why we're hard at work to future-proof the agency's approach to regulation so that it operates more efficiently than ever before. And most importantly, to make sure that we're not smothering growers, builders, and entrepreneurs with regulatory red tape. America's farmers, ranchers, and producers support manufacturers, transportation networks, local businesses, financial institutions, and countless jobs across rural America. Yet they're often taken for granted. They are in many ways the forgotten men and women of our economy. They work long hours, face unpredictable weather, fluctuating commodity prices, and global competition, all while navigating an increasingly complex regulatory environment. For years, federal agencies have layered regulation upon regulation onto financial intermediaries that service the agricultural industry. And in doing so, they've often failed to ask the farmers, ranchers, or producers who depend on these markets whether the rules work for them. Many of the Futures Commission merchants, swap dealers, and commodity trading advisors that farmers, ranchers, and producers rely upon for access to the markets are wholly owned by banks that are subject to onerous capital requirements. And of course, the Futures Commission merchants, swap dealers, and commodity trading advisors are separately regulated by the CFTC and the National Futures Association. In the wake of the 2008 financial crisis, the Dodd-Frank Act brought a substantial volume of new rules, definitions, and compliance obligations, creating a complex web of new requirements. By the end of 2016, the CFTC had finalized nearly 80 new regulations under the Act, significantly increasing the cost of participating in the markets. The number of Futures Commission merchants shrunk from roughly 90 before 2007 to less than 50 today. Farmers, ranchers, and producers who rely upon commodity derivatives for risk management had to address new hedging rules, position limits, swap data reporting, and the expense of hiring an array of lawyers and compliance personnel to figure it all out. The worst part of the story is that many of these regulations have proven to be unnecessary, duplicative, overly complex, and difficult to enforce. This is unacceptable. Farmers, ranchers, and producers depend on these markets to hedge risk, manage uncertainty, and plan for the future. Our responsibility is to ensure continued access to fair, efficient, and well-functioning markets, not to overregulate the marketplace, force innovators to conform with ill-conceived rules, and drive our innovators offshore. On a recent visit to a family farm, I spoke with an owner-operator who described how every new cost, from fuel, fertilizer, or equipment, to compliance with regulations, forces him to struggle to make a profit. That's why he takes advantage of every tool at his disposal to cut costs. I hear this story again and again from farmers and producers across the country, and that's why meetings like today's are so important. If the federal government continues to make it harder to operate a farm or a ranch in America, we shouldn't be surprised if fewer Americans choose to remain in the industry. That would be a mistake our country cannot afford. We cannot accept a future where America is dependent upon foreign countries and potentially our adversaries for the food and agricultural products we rely on. We must support our domestic producers, providing them with sound markets and opportunities to hedge their risks. That's why we've ended the prior administration's one-size-fits-all approach to financial regulation. Our goal will not be to regulate farmers out of our markets or overwhelm producers and the financial institutions that serve them with outdated or unnecessary requirements. Instead, we are pursuing a deregulatory agenda focused on identifying rules that no longer serve their intended purpose and eliminating roadblocks and red tape that have reduced productivity. That includes reviewing existing regulations where policies unnecessarily burden market participants and working with prudential regulators to make sure that the bank capital requirements don't inadvertently result in less intermediaries willing to service the agricultural industry. It also includes promoting greater transparency in the commodity markets to facilitate fair competition. To start, I've directed the staff to begin circulating the Commitments of Traders report on a bi-weekly basis, as opposed to the once-weekly cadence that we have today. We hope to begin doing so by the end of the year. We've also ended the prior administration's campaign of regulation by enforcement. Strong enforcement remains an essential element of maintaining confidence in our markets, but our emphasis is on pursuing fraud, manipulation, and abuse, not punishing honest market participants for technical or minor compliance missteps that create little risk to market integrity. Our objective is to protect markets while allowing businesses to innovate, compete, and grow. This effort requires strong coordination across government. That's why the CFTC is working closely with the U.S. Department of Agriculture to finalize a memorandum of understanding that will improve interagency coordination and provide producers with greater access to risk management tools. Today's meeting of the Agriculture Advisory Committee is an important part of our effort to ensure that our regulations are designed for the growers, builders, and entrepreneurs who use our markets, rather than academics sitting in an ivory tower. We want to hear directly from the people who know the agricultural industry best. Your experience helps us identify where regulations are working, where they're creating unintended consequences, and where reforms can make it easier to do business while preserving strong and resilient markets. This collaborative approach reflects the broader priorities of the Trump administration, which has made supporting American agriculture and reducing unnecessary burdens on Main Street a central focus. We share the belief that government works best when it enables economic growth instead of standing in its way. When we allow the invisible hand, rather than the government's hand, to guide our markets, the benefits extend far beyond agriculture. As we begin today's discussion, I encourage everyone to speak candidly. Your feedback will help the Commission facilitate a regulatory approach that protects market integrity while ensuring America's farmers, ranchers, and producers can continue doing what they do best: fueling, feeding, and clothing our nation. Now, to kick things off, I'm pleased to introduce Senator Tuberville here of Alabama, who I've enjoyed working with and getting to know over the past several months. He's served in the Senate since 2021 and is an essential member of the Senate Agriculture Committee, which is the CFTC's committee of jurisdiction. Coach also hosts his own agriculture committee that's focused on supporting Alabama farmers and producers. Coach Tuberville, thanks so much for being here. We're really glad to have you here today.
Thank you very much. It's good to be here. That was a great opening for this committee. Unfortunately, it makes too much sense. We don't have a lot of sense up here in D.C. I've been on the Ag Committee now for 6 years. And I'm going to read a little speech I got here because I got a great staff and they write these things down. They expect me to read them. And then I'm going to speak from the heart because I do have some opinions. Most people know that I will speak my piece because we got a lot of problems. But it's an honor to be here. And there's no doubt the backbone of this country is ag and our farmers, 100%. I grew up on a farm. I understand it. I understand the hard work and what you go through. You know, Alabama agriculture contributes a little over $77 billion annually to our economy, supports thousands of jobs across our state. I'm the first Alabama senator to be on the Ag Committee for some stupid reason in the last 25 years. We should have somebody on it every year. Ag Committee is different than other Senate committees I serve on. It's not as much political, and that's good. It shouldn't be. It should be about a regional and universal committee that works well together. Unfortunately, sometimes it's north versus south. Me and Chuck Grassley, who were good friends, I get on his ass all the time about cutting subsidies for ethanol. Of course, Iowa, they're big on corn. Hell, I'm afraid I'm gonna kill him one day of a heart attack. I keep talking about it, but it's good. It's a good committee. We work well together. You know, throughout my time in the Senate, my priority has been working roundtables around our state, and you just heard we have a committee, Ag Advisory Committee in our state, and I would suggest all states do that, and I've told my colleagues that. We're into livestock, specialty crops, everything, all the way down to seafood. And we understand, you know, there's a better understanding than you would think that what we have on the Ag Committee that goes around, even some of the people that know nothing about farming, they actually put the time into it to understand what's going on with our farms and our farmers and what we need to do to help. The CFTC is a big part of what we've done for the last 4 years and 5 years through 1 year through President Trump. You know, we were being attacked by the SEC of Gary Gensler and his group of trying to take digital away from, you know, the ag part, but we won't get into all that because this is about ag. But just to go to show you up here, it's more about power and be able to control something than anything else. The one thing I want to tell you is, again, traveling. I travel the country. Our farmers are on life support. Most of you know that. If you don't, you're living in an area that's not very consistent with what I'm seeing. You know, we lost during the Biden administration 150,000 farms and 25,000 farmers. We'll lose farmers this year. They can't pay their bills. They can't pay their farm loans. The input costs in the Biden administration skyrocketed. And they're bitching about what President Trump's doing in Iran. The prices are going up. And my God, all we have to do is look back in 2021, 2022, and 2023. Prices were skyrocketing. You know, machinery was just unaffordable. You know, cotton pickers had doubled in price, over $1 million for a cotton picker, which is unheard of. How do you make any money? How do you make profit? But the Biden administration made sure that they put pressure on all the farmers. And they did it in certain ways through things that unimaginable to the Americans. So I just want to tell you that that we're here for you. The Ag Committee, I would suggest that you work very close to them. We need a farm bill, but as long as we have Democrats in Congress, we're not going to have a farm bill. They're not going to vote for anything. They don't want anything to work. They love power, and they would destroy anybody to get that power. And it's just unfortunate. This country shouldn't work that way. It should work a way where we get together, we work together to help everybody. Now, farming is an area that, as I said earlier, it should be universal. Everybody should want it to work. Everybody should want our farmers to be successful. Tariffs should help. If I was the President of the United States and give me a magic wand, I would tariff the hell out of people outside this country. I'd get our farmers back on their feet. We have to save cotton. We have the Save America Act. Save America Act says you need to buy American cotton. Folks, our cotton farmers are struggling. Prices up a little bit this year. I think it's going to help. Are they going to make a lot of money? I don't know whether they're going to make enough money to pay off their farm loans. But at the end of the day, they have had losing season after losing season. I came from a business of coaching for 30 years. You have losing seasons, you get fired. Well, that's what happens in farming business. You have losing seasons, you don't get fired, you go out of business. And we've got to address that. And this farm bill has got to do that. Crop insurance, things that go along with that is huge for all of you. And again, the farm bill makes a lot of sense in a lot of areas. Sometimes, you know, we spend too much money in it. And people ask me this. They say, Coach, the farmers like subsidies. Nobody likes a subsidy, especially farmers. But we cannot lose our farms. We have to help our farmers out. We have to make sure they stay on their feet. And all that goes through the Farm Bill. All of it goes through the Ag Committee. So get involved with the Ag Committee in the House and the Senate. They carry a big stick. They carry a big stick, and you can get things done. Those of you that have Democrat senators in Congress, congressmen and women, get involved with them. Let them know how much it affects. Don't let politics get involved. If anything shouldn't have politics in it, it's the Ag Committee, because we represent people from all areas. And we go back to COVID. Look what happened during COVID. We found out that we do not do anything in terms of making any kind of medicines, any of our drugs. They all come from overseas. One of these days, we're going to look up and we're going to say, well, hell, we don't raise anything. We don't raise our own food, and that's a shame, because we grow the best crops in the world. We just need the opportunity to cut through the red tape, all this climate scam nonsense that they put on us that cost us $1 trillion, people. It cost us $1 trillion, all this nonsense that Al Gore and all these people were pushing on us. Now, people ask me about farmers and about conservation. There's nobody that loves their land and their water and their environment more than the farmer. Nobody. But they're going to put more rules and regulation on y'all than the law should allow. And we need to stop it. We have to stop it. That's all we do up here. This place loves rules. They love regulations. They love bureaucrats. They love funding things that we shouldn't fund. The money should go straight to the farmers if we're going to spend any money, and get the bureaucrats out of it. Our country's in trouble. I'm going to make a little speech here real quick, and I'm going to get out of here. I'm running for governor. I'll be governor next year of Alabama, and I'm out. I've had 6 years of it, and you can't get anything done up here. I'm in the fourth quarter of life, and I want to get something done for my kids and grandkids back in Alabama. But our country's in trouble. We're $40 trillion in debt. We had a guy this morning on the stand at a hearing that was over COVID. He killed 9 million people across this world because of his lies and deception. And he got up there and looked like he needed to be in jail, didn't answer one question. And that's how this country's been run, by lies and deception. We lose $100 million an hour. I want you to think about this. $100 million an hour to fraud in the United States of America. 24 hours a day, 365 days a year. That's $1 trillion. $1 trillion. It's just mind-boggling to me. And you know what? Only one trying to address all that's President Trump. If you don't like him, fine. I don't care. It doesn't make me any difference. But if you like your country, you better be on the side of somebody that likes somebody that makes people accountable. Because the guy's got a good business sense, really good business sense. And he understands what's going on. Now, he's gotten us in some things that we all wonder, why are we doing this or that? But at the end of the day, his mind's in a good place. And he loves farmers. And I've talked to him about things that are going on in farming, whether it's seafood, whether it's cotton, whether it's soybeans, whether it's corn. Folks, we got to get on the same page. We got to understand that the same page is stay together as farmers and fight for your rights. But get close with your ag committee. Get close with the people that represent your ag, because that's where it starts. You can have these groups in there fine, and the chairman's going to do a great job in his job. But you got people that you can talk with and convince and let them know your problems. Tell them your problems. Don't let your problems go unsolved, because they can be solved up here. It just takes a little bit longer. So y'all have a good meeting. Enjoy what you're doing. Again, let's make farming better. Let's give the farmers a chance, because the last few years, they hadn't had a chance. You know that. You hadn't had a chance. Do the best you can do. God bless all of you. God bless America. Thank you. Got to get back to work.
Thank you to Senator Tuberville for joining us, and to Chairman Seelig for your opening remarks. Now we can move forward with the rest of our meeting. Before continuing with the agenda, I want to remind everyone to please keep all comments, discussion, and feedback related to agriculture and the agricultural industry specifically. Now I'll mention a few logistical items. First, for meeting participants, if you are attending in person, please ensure your microphone is on when you speak. This meeting is being simultaneously webcast, and it is important that your microphone is on so that the webcast audience can hear you. For committee members who would like to be recognized during a discussion, Please change the position of your place card so that it sits vertically on the table or raise your hand. If you are participating virtually, please only turn on your camera when you are engaging in discussion. Please unmute your video and microphone before you speak, and please mute them back after you finish speaking. And for committee members who would like to be recognized during a discussion, virtually, please use the raise your hand feature or message me and I will alert AAC Chair Prosser. When the chair recognizes you, please identify yourself before you begin speaking and signal when you are done speaking. If you are disconnected from the meeting accidentally, virtually, please close your browser and log in again. And if you require further technical assistance, please message me in the chat. Now, I would like to turn to AAC Chair Prosser.
Thank you, Emma. And thank you, Chairman Seelig, for joining us and for your thoughtful opening remarks. I've got to tell you how delighted I am to hear about biweekly Commitment of Traders report, and it shows the idea that the CFTC is behind transparency. It's been something we've been working for so long. Thanks for getting it across the line. Let me also take a moment, as this is our first meeting as the reconstituted Agriculture Advisory Committee, to thank each of our committee members for your willingness to serve. We are grateful for everyone in this room that is returning for another period of service on the committee. And we are grateful for all the new members of the committee here to offer us new perspectives. This committee's work matters, especially in our current environment. We're meeting at a moment when the markets we oversee are navigating significant change, the rise of novel market structure in digital assets and prediction markets, and the advent of true 24/7 trading and clearing, the Basel III proposal that impacts how we clear trades, potential changes to the frequency of the Commitment of Traders report, potential risk management gaps between the CFTC and USDA product offerings, among other new policy issues. Chairman Seelig has been clear from day one that new market structures are not going to be one size fits all. This is the venue where we can explore ways that new technology could promote new efficiencies in our markets, and even more importantly, where market structures designed for different commodities might not benefit or might even hurt the efficiency our markets have today. The insight and expertise around this table will be essential as we work through them. With that, let's turn to our first topic. Our first agenda today is the Basel III Endgame proposal. It is my pleasure to introduce our first guest speaker from the Federal Deposit Insurance Corporation, Federal Reserve Board, and the Office of the Comptroller of the Currency, who will discuss updates on the Basel III Endgame proposal. I want to note that the prudential regulators are still undergoing a public comment period, and so they cannot take any questions. Once they finish their presentations, they will head out and we'll have an internal AAC discussion.
Hey guys, we have y'all right here. So these four.
Okay, good afternoon. We are happy to be here today to provide an overview of the bank capital rulemaking proposals. In March of 2026, the Office of the Comptroller of the Currency, or the OCC, the Federal Reserve, and the Federal Deposit Insurance Corporation, or the FDIC, approved two notices of proposed rulemaking that would modify the regulatory capital requirements for all banking organizations. Given that we are here at the CFTC today, we're going to focus most of our discussion around the proposed changes to the capital requirements for derivative transactions. Now, these two notices of proposed rulemaking include, one, it's a proposal that modifies the capital requirements designed for the largest and most complex banking organizations. This proposal, it's commonly referred to as the Basel III proposal, sometimes the expanded risk-based or ERBA proposal. This proposal is largely based on the 2017 Basel Agreement, with changes tailored to the U.S. economy and banking industry. as well as lessons learned from the 2023 proposal. And for context, this 2017 Basel Agreement refers to a capital framework that international regulators, including U.S. banking regulators, worked on together to set a minimum framework for internationally active banking organizations. The U.S. banking regulators issued a proposal in 2023 that closely followed this agreement. That 2023 proposal was not finalized, but feedback received did inform the recent 2026 proposals. This Basel III proposal would also be optional for all other banking organizations to elect. And the second proposal was designed to modify the capital requirements for all other banking organizations. And this proposal is generally referred to as the standardized approach proposal. And the modifications made in this rulemaking were intended to better align with the recalibrated capital requirements in the Basel III proposal while still remaining a simpler framework. Now, the public comment period on both of these proposals closed on June 18, 2026, and the interagency proposals received over 400 comments that the agencies are in process of considering. And at a high level, what these proposals do, they would work together to improve the regulatory capital framework by better aligning capital with risk and simplifying the framework where possible. So for example, under the current framework, the largest banking organizations are required to calculate their capital requirements twice, once under a standardized approach and then again under an internal models-based approach. The banking organization would then hold a higher amount of capital. Under the capital proposals, this dual calculation requirement was proposed to be removed so that the largest banks would only have one minimum capital requirement to calculate. Consistent with the objectives I mentioned above related to enhanced risk sensitivity and simplicity, the proposals seek comment on a broad range of changes to the regulatory capital framework for banking organizations. But again, as I said before, for purposes of today's overview, we're going to focus on the key changes made to the capital requirements for derivatives, as we believe that is most relevant for you all here. And as we describe the relevant policies being considered in the 2026 proposal, we will also draw comparisons to the 2023 proposal where appropriate. And these changes that I described today also apply to both proposals. So for derivative transactions, a banking organization's capital requirements generally include market risk, counterparty credit risk, and changes in the value of counterparty credit risk, which is also known as credit valuation adjustment or CVA risk. With respect to market risk, as compared to the 2023 proposal, the 2026 proposal reduces barriers for banking organizations to be able to use their risk-sensitive internal models to determine their market risk capital requirements. Although consistent with today, use of internal models would require regulatory approval. The 2026 proposal also raised the activity-based thresholds at which a banking organization would be required to use the market risk framework, as well as the CVA framework. For counterparty credit risk, the 2026 proposal would allow large banking organizations to recognize the risk-reducing benefits of qualifying cross-product netting arrangements for derivative transactions and certain repo-style transactions. And this is an example of improved risk sensitivity that was not included in the 2023 proposal. For CVA risk, the 2023 proposal required a CVA capital charge for client-facing derivative transactions for cleared trades, which was consistent actually with the Basel Agreement. This requirement, however, was criticized as it was inconsistent with CVA risk in the accounting treatment of such transactions. So in other words, the 2023 proposal would have required a capital charge for CVA, even though for accounting purposes, the banks would not have to calculate such a P&L amount for this group of derivative exposures. So the 2026 proposal instead would remove the capital requirement for CVA risk for client-facing derivative transactions for cleared trades. This policy change should serve to support banking organizations serving their clients in a bank's role as a clearing member. Relatedly, I'd also like to highlight an existing feature of the capital rule, which includes a lower risk multiplier for commercial end users, which should include many of the stakeholders here today. So the proposed implementation of the CVA risk framework would build on this existing policy to support banking organizations, again, in their role as clearing members. And finally, as I mentioned at the beginning of my remarks, the two rulemakings are in the proposal stage. And as part of the proposals, the agencies included a number of questions to solicit feedback from the public to help prudently achieve risk sensitivity in the bank capital framework, including for clearing-related activities and transactions with non-financial counterparties, which should be of interest to many here today. So that concludes my remarks. Thank you again for having us.
Thank you. Thank you to the representatives from our prudential regulators for joining us. Before we begin our discussion on Basel III, a few reminders. For committee members participating virtually, please use the raise hand feature to ask a question. For members in person, please turn your name card vertically. Now let's kick off our discussion on Basel III. Does anyone have any comments?
Thank you. My name is Ananda Radhakrishnan with the American Bankers Association. Chairman Seelig, thank you for sponsoring this committee. And Emma, thank you for organizing it and for inviting me. What the Basel III proposal doesn't take into account is that in the United States, clearing members are not banks. In CFTC regulated markets, clearing members for customers are FCMs. They're not the banks. In the securities markets, they're broker-dealers. That may not be the case in other countries, but it is the case here. So to impose a requirement on the, say, the holding company, the bank holding company, is actually whacking them twice. Because the FCMs themselves have fairly significant capital requirements. So it's not clear to me that there's a recognition of the fact that by imposing capital requirements for client-facing cleared derivatives transactions, that you're unfairly penalizing the bank holding company. And there's no recognition of the fact, there doesn't appear to be a recognition of the fact, that the clearing entity, the clearing member itself, the FCM, has capital requirements. In fact, not to make fun of this gentleman, but he was talking about banks clearing for customers. In the United States, banks do not clear for customers. Because to do so, you have to be an FCM, and no bank is an FCM. So I'm hoping that, I think the FIA, the Futures Industry Association, is probably going to write a comment letter, because, and they've done so previously. And I hope they make that particular point, that by imposing requirements on bank holding companies, you are unfairly penalizing them and you're not giving them a chance to compete for the business of the agricultural industry. Thank you.
Thank you.
Nelson Neal, Futures Industry Association. Thank you for inviting me to speak. Wanted to follow on to the comments that were just made and really get to the heart of the matter. We represent non-bank FCMs, bank FCMs, and other market participants. But from a bank FCM perspective, if those FCMs offer cross-product netting and lower margins, they ultimately have fewer dollars sitting there in their margin accounts. When prudential regulators come over top and create additional capital requirements for those banks, then ultimately decisions have to be made because you've got a mismatch. Fewer dollars coming in and then still having to post the same capital dollar requirements as before. The end game in this is ultimately decisions being made by those bank FCMs, and that is where do I point my business to? And as sad as it is to say, I suspect agriculture is further down the list in terms of business opportunities than perhaps all of us would like for it to be. So two things happen. Either the increased cost based on that mismatch eventually get passed on to customers, or those FCMs make decisions to make cuts to particular lines of business. And I think all of us in this room are pro-choice, pro-competition, and pro-optionality. And if we continue down the path of the 2023 types of proposals and don't make changes, I think we're going to be left in the agricultural industry with less choice and less service. Thank you.
Any other comments? I'm going to take the chair's prerogative of asking a question then. And this is to you, Joe. But please, anybody comment. Given what we just heard from Nelson, if bank FCMs become more selective or exit the market due to bank capital requirements, are there enough adequate capacity and capital in non-bank FCMs to accommodate the increasing demand? There you go.
Looks like I'm being called on. Of course, I have a couple hats I wear, representing the National Council of Farmer-Owned Cooperatives, as well as my day job at a non-bank FCM. The ability for agriculture to interact with FCMs and thus have market access has dropped dramatically in the last few years. You yourself, Chairman Seelig, cited that in your opening remarks, going from 90 to 50. And in my career, it's much larger than that. Is there adequate capital? I believe there is adequate capital. It's that allocation of capital and where that capital gets used, and then how decisions get made from there that is impacting agriculture's access to our marketplaces. So I'm going to answer your question and say, yes, there's capital, but it's not always allocated the way that is best for agriculture producers to access our markets.
Thanks for letting me put you on the spot, Joe. Any other comments? Would the sponsor have questions or comments?
Close. Well, I just want to thank everyone for this conversation. I want to thank in particular our prudential regulators for coming in here to provide a timely update. The new Basel III Endgame, as I sort of referenced in my opening remarks, it's a strong step in the right direction to fix some of the issues that the last administration put in place, but we've got to do more work. So we're looking forward to continuing the conversation and working with the prudentials to make sure that we address some of the concerns raised in this room, as well as any other issues that some of the groups might be raising to the prudential regulators. We're focused on reducing any sort of burdensome rules and regulations that are preventing farmers, ranchers, and producers from being able to access FCMs and access our markets, because of course, as I laid out earlier today, it's so important that these constituents continue to have the ability to manage their risk and use these hedging tools in well-functioning markets. And so we'll continue to focus on making sure we get this right, but we're getting close, and I'm looking forward to working with the prudential regulators to get this across the line.
Thank you, Mr. Chairman. With that, I think we'll go to our next topic. We have Jess Harris, Director of the Division of Data at the CFTC. She will be providing an update on the Commitment of Traders report, and then we will open up for discussion on the COT report amongst AAC members. Jess?
Thank you. Good afternoon. My name is Jessica Harris, and I'm the Director of the Division of Data here at the CFTC. I want to thank you for the opportunity to speak with you today about the Commitments of Trader report, or COT. For decades, COT has been a cornerstone of market transparency, especially in our agricultural futures markets. It is a tool that farmers, merchandisers, commercial hedgers, agribusiness, and analysts alike rely on to understand how different participants are positioned in the market. Before I discuss the COT report, allow me to speak briefly about what the Division of Data does here and the function that we serve. To put it simply, we are the CFTC's data backbone. We ingest, validate, transform all of the core data the Commission collects and relies on, from trade capture to swaps data to large trader reporting. So we have 5 core functions. Data intake and engineering. These are the pipelines that bring in the statutory data. We process it, we validate it, and we make it available to the Commission. We also have a data quality and standards branch. This function works with exchanges and reporting firms to strengthen validation rules, and align testing so data comes in clean and consistent. We have an analytics branch. We provide analytical support and tooling to all divisions that accelerate investigations, market reviews, and policy analysis. We also manage technology systems that we have built or procured that assess risk, run processes, perform surveillance activities, and others. We are continuing to modernize these systems to support our ingestion pipelines as we see more data coming in with a number of reporting firms. Through these modernization efforts, we are continuing to improve upon our bulk submission processes, tuning surveillance, supporting AI governance, and enterprise analytics. And finally, we create public transparency products. So this includes COT. We publish a COT, which is one of the most widely used market sentiment data sources. So why does this matter? Because high-quality data not only reduces operational burden at the Commission, it reduces rework for industry, improves regulatory certainty, and supports markets that function with integrity and transparency. So now I'll lay out how we build the COT report. So COT is grounded in daily position data that we collect from 300 reporting firms, including FCMs, clearing firms, and foreign brokers. So we reconcile that data against exchange data and other reports that we collect. Our teams calculate positions and classify reportable traders based on primary market purpose, commercial hedgers, swap dealers, managed money, and other reportables. So we publish this report in two places, CFTC.gov and the Republic reporting environment. And so here are some statistics. The CFTC.gov gets 195,000 views per month. On our public reporting environment, the COT reports gets 110,000 views per month. And the number of API calls on our public reporting environment for COT is over 6.5 million. So these statistics not only demonstrate its popularity, but its importance. Agricultural producers and the businesses that support them manage risks tied to weather, global supply chain, and prices that can change in the blink of an eye. The COT report helps to bring clarity to those markets. It doesn't predict the future, but it does help all of us better interpret market behavior. So we recently invited public comment on potential updates to the COT program, and the response was significant, with over 100 total comments. That level of engagement sends a strong message. People care deeply about the transparency the COT report provides and the need to maintain protections to keep sensitive information secure. Across industry groups, associations, and market participants, a few themes came up. Protect confidentiality, modernize where it makes sense, and improve usability. Market participants want assurance that increased detail won't reveal proprietary trading activity. Many stakeholders support exploring improvements in classification, timeliness, and clarity. And we received a number of comments suggesting expanded formats, harmonized historical classifications, and more user-friendly data schema. So these themes align closely with work already underway inside the agency, including data modernization and analytical tooling. So as we review the feedback and consider possible enhancements to the COT program, we're grounding every step in three commitments. Stability. The agricultural economy depends on these markets. Any modernization will protect the integrity of long-running data sets that farmers and agribusiness and analysts rely upon. Confidentiality. We will not compromise trader privacy or reveal strategies. The trust that it underpins effective market oversight is non-negotiable. And finally, transparency with purpose. The COT should continue to serve producers, merchants, advisory groups, and others who use this information and adapt as markets evolve. So in closing, I want to thank all of you, industry members, associations, the advisory committee and staff, for your engagement and partnership. Your feedback helps us to keep the COT report strong, reliable, and relevant. We look forward to continuing that dialogue as we work to maintain markets that are transparent, fair, and resilient, and markets that American agriculture can count on. Thank you.
Thank you, Jess. At this time, I will open the floor to AAC members for questions or comment on the COT report. As a reminder for committee members participating virtually, please use the raise hand feature to ask a question. For members here, please turn your name card vertically.
Thank you. We very much appreciate the increased transparency that you'll be giving these reports for listening to the market and these requests. So that's really valuable. One point I think we'd like to raise is in periods of dislocations, for example, shutdowns, the delay schedules that the COT has ran through does have quite a few impacts on market discovery, especially on clarity positionings. So I'd like to see if this would be a point of consideration for future changes in expediting some of those delayed reports.
Thank you. Yeah, your feedback is important to us, and as I said in my comments, we appreciate the usage of this report. And so with those comments and your comments included, we're looking to operationalize them, including speeding them up and frequency. So we're looking into it, and we're making some improvements. So thank you.
Neil, maybe introduce yourself. I think that not everybody can see your name card.
Apologies. Neil Donovan with Bungie. I'm in St. Louis, Missouri.
Thank you. Gabe.
Good afternoon. My name is Gabe Affalion with Cargill. Firstly, thank you, Commissioner. It's a pleasure to be here. And thank you, Jessica, as well, for the description. Certainly echo Neil's comments on potential improvements, but mostly want to say we are ardent supporters of the principles you line out, which are transparency, confidentiality, and certainly underpinning the importance of this data for the market to be able to interpret. So the progress that's been announced here today is certainly welcome. And I would just simply say we hope that through that progress, we also see marginal improvements, just like Neil said, in periods where there might be disruption into normal function of government. Are there ways to circumvent that, to avoid that disruption? We've seen evidence of how that can impact the market's ability to locate what is market sentiment, and it's not. It wasn't surprising to see the drift even amongst the most analytically savvy firms in estimating what that market sentiment had done within a few short weeks of the absence of those reports. So they are absolutely essential. So anything we can continue to do to increase the frequency, not only in number of reports per week, but the distance between the cutoff dates and the release would be most welcome. So thank you.
Liam.
Thank you very much. Liam Smith with the Principal Trader Group. Really appreciate it. Think this is a tremendous step, echoing what the others have said so far. I think it would be helpful also to hear, to follow on the question that's already been asked of what would it take, what is necessary to add more reports? What other resources would be needed to increase the frequency? As you can hear, there's a lot of interest in this report. What would it take for that kind of, this is a great first step. What is needed to make additional steps would probably be helpful for all of us to understand, if you could share that.
Sure. So I'll lay out a couple of things that we're looking into to make improvements. So one of those things is modernizing our infrastructure, right? So I talked earlier about the pipelines, the ingestion pipeline, so we're working on that. The large trader report, which we rely upon to calculate those positions, is also going through a format change. So as of next year, it will be in FixML. So it'll be easier for us, right, to digest that information. With respect to resources, we will be looking into how much or like what that lift is to increase or compress the schedule. But a lot of the work comes with reconciliation and classification, right? So we're looking into automating our processes to go from like a manual reconciliation to more automated to make that reconciliation faster. In addition, we're looking into other ways to publish the report. We've seen from the statistics that it's almost equal in the number of views, right, on CFTC.gov or the public reporting environment. So it takes us actually less time to publish to the public reporting environment than it does to the CFTC.gov page. So we're also looking into that. So really just trying to like expedite our processes as best we can. Yeah.
Buddy.
Thank you, Mr. Prosser. Chairman, Jess, thank you for your work on this. I agree with everything that's been said. Real expeditious deployment in response to the outcry from the community, so that's to be commended. Maybe indicative with the fact you're both drinking a Celsius here during the meeting. You're actively engaged. We appreciate that. As we noted in our public comments, we do have one flag in addition to the COT report, the Cotton on Call report, which is a legacy concern of ours. And while we appreciate the special treatment once a week, acknowledging that we're the only market that has that report bears a lot of questions. And you, Chairman, you've been quick to engage and have a conversation, and your team we've recently met with and had very constructive conversations. And I would ask that we be able to continue that dialogue, maybe not simply through requests for public comments. We concede that there is not consensus among market participants that we should, as we suggest, sunset the public dissemination of this report. But rather than that, acknowledging that we've already queried the community and know where that sits today, a very careful examination of its merit, of its relevance, and how it can in fact potentially harm commercial market participants, hedgers particularly. So thank you for your interest there, and we appreciate the opportunity to continue to engage on that topic. Buddy Allen with American Cotton Shippers. Thank you.
Thanks, buddy. Derek?
Derek Salmon, CME Group. Mr. Chairman, thank you for reconvening the AAC. It's nice to have us back around the table talking about very important issues that are impacting this market. Ed, congratulations on chairmanship. Appreciate your handling and herding the cats on this. Just wanted to note that at CME Group, we fully subscribe to the support of the CMC comment letter on the support of moving forward with changes. We have set an all-time record volume of 2.1 million contracts today in our ag complex this year. We are seeing expanded activity across all of our client segments. Our fastest growing client segments are corporations, banks, and commercials, and buy-side customers. I think more transparency, more granularity benefits all. Our twin focal points at CME Group is price transparency and risk management. We think that enhancing this report takes a strong step forward to helping more participants actively participate in this market with better information. A lot of folks think that CME actually produces these reports. We get a lot of input on how they can be improved. We pass that along to Jessica, you and the team. So just wanted to log our support for these changes.
Emma, do we have anybody on the phone? Oh, I'm sorry. Melissa.
Good afternoon, Melissa Bailey with USDA's Agricultural Marketing Service. We produce a significant amount of data as well through our market news service. This could be daily information on price and volume in the livestock, grain, cotton, and more sectors. And just wanted to make a standing offer to Jessica if it's ever helpful. We have worked through probably similar challenges in terms of dissemination, publication, automation, and probably struggle with some of the same things that you're working through. So if it's ever helpful to get our teams together to brainstorm on those things, we'd be happy to do so. Thanks.
Thank you. I appreciate that.
Anybody else? Thank you, AAC members. Would the sponsor have questions or comments?
Well, I just want to thank Jess for all the hard work on getting this across the line and for all of the input we received. I think this began as an idea about 6 months ago. We were getting a lot of feedback on why is this report coming out once weekly as opposed to biweekly or even more frequently than that. And we've really worked quickly to get this in the right place. And we're hoping, as I said, to launch this biweekly by the end of the year. So we thank everyone for their feedback, both today and throughout this process. And really, I think everyone should give Jess a round of applause for all the hard work, because this has been a really big lift.
Thank you, Chairman. Moving on to our next topic, which is potential risk management gaps between product offerings in the CFTC regulated derivatives market and the United States Department of Agriculture. It is my pleasure to introduce Heather Manzano. I apologize if I butchered that. Associate Administrator of the Risk Management Agency, and Mary Catherine Cromley, Senior Advisor, Farm Production and Conservation at the USDA, who will both be joining us for the discussion. Ms. Manzano, would you please start by providing some comments on the USDA RMA's current risk management tools?
Sorry, thank you. Good afternoon. Heather Manzano, and as was stated, I'm the Associate Administrator with the Risk Management Agency. I'm glad to have a few minutes to talk with you about some of our programs this afternoon. The Risk Management Agency, for anyone who may not know, administers the Federal Crop Insurance Program. The Federal Crop Insurance Program is about a $200 billion program providing risk protection to farmers and ranchers nationwide on a variety of crops as well as livestock products. Under our crop portfolio, we have several different insurance type programs. We've got a multi-peril crop insurance product that covers about 130 or more crops, hundreds more actual crop varieties. We also have a rainfall index product, 3 products available under the rainfall index program. And then we have what's known as a whole farm revenue product, which covers, as it states, the whole farm, everything that's grown. It's really for diverse type operations. Those products pay out on yield or revenue or both. And the revenue is clearly our most popular product. When you start talking about some of the more common crops like corn, beans, wheat, you're talking about market penetration of high 90% of producers in the country have crop insurance. So it's not something that is an add-on, it's a almost must-have. So that is our main product, very reliant as far as those row crops on the futures markets. When it comes to our livestock products, we have 3 primary products. Our livestock revenue product, which covers decline in price. That's a very popular product. About $22 billion in coverage on that one. We have livestock gross margin, which is actually covering the difference between the livestock revenue and the feed. That one's a smaller program, only about $10.5 billion and in liability. And then we have our dairy revenue protection, and I'll just defer to Dr. Newton on any questions with that. Our dairy revenue protection covers milk production and is probably our newest product at about $12.5 billion in liability, covering about 50 billion pounds of milk. None of our products in the livestock area cover animal mortality. All of them are just either revenue or margin, yield, but we don't actually cover the animals themselves. And so that's just, I guess, a high glimpse of what we cover under the crop insurance program.
Thank you for your comments. Now we will have Ms. Cromley from USDA FPAC.
Good afternoon. My name is Mary Catherine Cromley. I'm a senior advisor for the Farm Production and Conservation Mission Area. I'm here to talk a little bit about the programs offered through the Farm Service Agency. In general, the Farm Service Agency offers a variety of commodity and livestock programs to help producers in times of price declines and disaster. Most producers in the country do business with FSA at this point because we do cover quite a wide range of different options for producers. Probably the ones that producers are familiar with the most are ARC, Agricultural Risk Coverage, and then PLC, Price Loss Coverage Programs. Payments for these are based on historical plantings, and there were some significant improvements in the One Big Beautiful Bill Act, or the Working Families Tax Cuts Act, that increased reference prices for producers and also added additional base acres for producers who may not have had the historical plantings whenever base was established. And the base acres are what we base all of our payments on. We can get into that a little later if y'all want to, but that is a little complicated to explain. We also offer a variety of disaster programs that trigger through different disaster events across the country. Not all of our programs require disaster designations, but offer programs that cover disasters for livestock and forage especially, and then cover also increased expenses for transportation in certain situations. So we have a wide range of programs there, but happy to, as well as some marketing assistance loans and loan deficiency payments as well that help producers be able to delay their marketing if prices aren't great at harvest and be able to take advantage of better prices down the road. So that's a general overview. Happy to answer more questions as we go on.
I can tell you as a Kansas wheat producer, thank God for ARC payments. Thanks to the USDA for joining us. Next, I'll turn to Dr. John Newton from the American Farm Bureau.
Thank you so much, and thank you for the opportunity to be here. The American Farm Bureau Federation, we're the largest farm organization in the U.S. We have just over 5 million members across the country, and we're probably the only farm organization that does not have large-scale end users as part of our membership. So we really do represent small and medium size farmers around the country. I believe 65% of our members identify themselves as medium to small farmers. So I can't say enough how important these markets are to our members in terms of price discovery. The Commitment of Traders report gives us valuable information on the market sentiment. But I will say that you know, in my years at Farm Bureau and even prior to that, I don't think a lot of farmers are going to be the first users of these derivative instruments. I think they lean more heavily on the crop insurance products that RMA offers. They lean on the Farm Bill tools that Mary C. mentioned, ARC and PLC. And one of the challenges that farmers face is just the cost of utilizing these tools, margin accounts. It can be very cost prohibitive, whereas the use of crop insurance, premiums aren't due up front. Same thing with the livestock based policies, those premiums aren't due up front. So for farmers in a farm economy, as Senator Tuberville mentioned, that's pretty tough. Having that cash, having that liquidity on hand is pretty important to them going into a growing season. So they do utilize crop insurance and other tools to manage the risk. One of the other challenges I think farmers often have with these markets is the speed at which they move. You know, a farmer will, and you mentioned how many times the Commitment of Traders report is hit, 6 million times, I think, in a week or a month, however many times that was. The markets will move so fast after a market moving report, and farmers just don't have the ability to capitalize on how quickly those prices are moving. So again, those are other reasons why these RMA tools are so important. But we know these RMA tools depend upon a strong futures market for them to function. Ms. Manzano did mention that the dairy revenue protection product, we built that at American Farm Bureau Federation many years ago because a lot of dairy farmers did not have good options to manage their risks. And we also worked through the Bipartisan Budget Act to remove the cap on livestock insurance. There was a $20 million cap. We were able to remove that. So I think because of our efforts, livestock insurance has really taken off across the U.S. But we do hear from our members quite a bit that there are gaps in coverage. I think specialty crops would be one of the largest areas where our members feel like they can't adequately manage their risk. You mentioned whole farm revenue as an option, but with the farmers that I've talked to, that's like doing your taxes. It's not exactly an easy plan of insurance to take out. So we have specialty crops, poultry. Our poultry producers are desperately in need of some sort of risk management or index-based product, which I believe RMA is working on. We also hear from our farmers on the need for aquaculture products, commercial fishery products, more shallow loss products. But one thing I will add is for some of our small and medium-sized farmers, access to these crop insurance products can be a challenge. If you're a 25-cow dairy in Vermont, you're not the first call that someone gets to sell dairy RP to. You might not even be on the call sheet because of the incentive structure that's there with risk management products. So I think an emphasis to make crop insurance more accessible for small and medium-sized farmers would be much appreciated. But we very much appreciate the opportunity to be here and look forward to the conversation.
Thank you, John. Now I'll turn to Ms. Kate Thompson from the National Cattlemen's Beef Association.
Thank you. Good afternoon, everyone, and thanks for the opportunity to be here today. Really appreciate, Ms. Chairman Seelig, Emma, everyone who went into really organizing this meeting. So looking forward to the discussion. My name is Kate Thompson. I'm a Director of Government Affairs for the National Cattlemen's Beef Association. We represent cattle producers across the United States, large, small, really the whole gamut. We have around 25,000 individual members and around 175,000 other members represented through our 44 state affiliate organizations. A lot of our members do use both a lot of the USDA programs as well as the futures and options market. So we kind of play a dual role there, working on both of those issues for a lot of our members. I think when we talk about ag risk management, futures are rightly viewed as one of the big mechanisms and one of the positive ways that a lot of our producers can manage their risk. Like Mr. Newton mentioned, sometimes, it's not very accessible for a lot of producers. For your smaller operations or even your mid-size operations, there's just a lot of other things that go into, operating and purchasing and trading futures contracts. I think that, that's why certain programs like the Livestock Risk Protection Program, as well as the Livestock Indemnity Program are so critical and truly complement the futures markets. I think if we have multiple options, we can really help a wide range of producers in that realm. LRP, a lot of our members use that. It's a federally subsidized insurance product. Essentially, it protects from a price decline, so producers can pick a coverage, set a price floor, while also allowing producers to benefit if the market actually moves positively and in their favor. We have a lot of producers that work on this. We have been working on this. Our organization recently put together, an LRP task force, kind of looking at other ways to expand coverage. I think there has, over the years through the LRP program, there's been some great enhancements. I know USDA and Congress have worked a lot to make the program more accessible. And I think continuing to find ways to really improve the program would be a great step. And I know you all are already working on that. One of the things that we have started exploring as kind of a gap that has popped up here and there really is looking at coverage options for bred cows, bred heifers, and beef cull cows. So we've been having some discussions internally with our organization about finding ways to protect some of that breeding livestock that, that very high value. And so we're going through that task force right now, looking at recommendations on expanding into that realm. I think especially as we look, towards retaining and rebuilding this U.S. cattle herd, the more options there are and the more coverage options there are for our producers is a really good step. I think, again, with the Livestock Indemnity Program, it's a very well-used program. This program essentially provides assistance to livestock livestock owners that experience losses, due to extreme weather or due to, predator attacks from federally protected species, as well as disease issues that are popping up. And so I think that's a critical program. And I think if we can continue to work and look at ways to improve that, I know, again, there's been a lot done through USDA and Congress on continuing to find ways to improve those programs. And I think that's something we definitely want to keep exploring. Ultimately, effective risk management is a lot of different tools. We have producers that use all of these different tools. And I think ensuring that these products, evolve as the industry evolves, I think is kind of a key piece to this. When the industry changes, the tools that they have need to change as well. And so, again, thank you. Look forward to the discussion and appreciate being here.
Thank you, Kate. Now I'll turn to Mr. Matt Frostick from the National Corn Growers Association.
Thank you, Chairman Seelig and staff, for sponsoring this Ag Advisory Committee and for calling today's meeting. I'm Matt Frostick, a corn farmer from Applegate, Michigan. I am currently serving as the first vice chairman of the National Corn Growers, and I will take over the president in October. Founded in 1957, NCGA represents more than 36,000 dues-paying corn growers in 48 states and interests of more than 500,000 farmers who contribute through corn checkoff programs in their states. NCGA and our affiliated associations in 27 states work together to help protect and advance corn grower interests. I want to echo the comments from the USDA officials and emphasize the importance of the commodity programs, crop insurance, and the suite of disaster economic assistance programs. In 2025, corn growers purchase federal crop insurance on over 90 million acres of corn. When you include optional endorsement policies, corn growers had insurance coverage on over $63 billion in liabilities. Last year's One Big Beautiful Bill Act included investments in the commodity and crop insurance programs, including several recommendations from corn growers to strengthen these tools. Commodity markets also provide important risk management tools for producers and agriculture and industry, including direct hedging opportunities and through price discovery. Among agriculture commodities, corn futures are considered highly liquid with high volumes of daily trade. As we talk about potential gaps in risk management tools, low commodity prices and high input costs are top of mind for corn growers and my fellow producers across this country. A year ago, NCGA launched an input task force to identify solutions to bring costs more in line with today's commodity prices. I'm leading these efforts along with other corn state associations. NCGA recently released a report focused on comparative analysis of corn and soybean input costs in the United States versus Brazil. The findings show that the U.S. growers often pay more than their Brazilian competitors, a difference that matters for farm profitability, the global competitiveness of U.S. agriculture, rural economies, and the long-term strength of U.S. agriculture. Some of the key findings were important in this conversation include margin pressure is becoming a structural pressure on farm viability. Input cost transparency should be part of the broader conversation about cost structure and market function. Farm policy should reflect the full cost of staying competitive. While the USDA has very solid programs focused on commodity prices, yields, or both in terms of revenue, input costs are not easily factored into the program design at the farm gate level. In federal crop insurance, margin protection policies for livestock and row crops do exist. However, there are several issues that have kept participation fairly low for corn, including current margin policies designed for area-wide losses at county level, not at a producer level. The producer deadlines are in the fall instead of typically spring deadline for underlying policies. And the margin is determined by a basket of goods that may not match grower practices. USDA and our industry partners are aware of these concerns and are continuing to innovate. With the futures market, input costs are not easily hedged at a scale suitable for most producers. For example, it is difficult to have enough useful liquidity in a fertilizer contract because of the significantly more localized pricing of a fertilizer like urea or phosphate. Though some smaller contracts exist, the most active urea contract for 10 tons, which is too big for most smaller family farms to participate, leaving them without a tool to nimbly navigate or price volatility. NCGA is continuing to work these issues and appreciate the opportunity to highlight the growing challenges producers face. As we look to the future, we are also working towards sustained growth in demand for U.S. corn and corn products like ethanol, sustainable aviation fuel, maritime fuel, and bio-based products. Thank you for your time.
Thank you all. At this time, I'd like to open the floor to questions and comments from the AAC members on potential risk management gaps, such as the new products or adjustments to existing products. As a reminder for committee members participating virtually, please use the raise the hand feature, and those of you here, please put your cards up vertically. I think we figured that one out by now. All right. With that, I'd like to entertain questions. Joe.
Yes, Joe Barker, National Council of Farmer Cooperatives. The comment I want to make is about the basis of our supply and demand reports. And so my question is, we get acreage estimates, which goes into the overall calculation and the supply of what's raised for any of our commodities. We get different reports from NASS, that we get from the RMA, that we get from the Farm Services Administration. And for those of us that are trying to have transparent markets that determine price, using different acreage estimates that can change throughout the year. This past year, the corn acreage, planted acres, was changed in February for the crop that was planted the spring before that. Is there a way that we can streamline, just like we streamlined the Commitment to Traders report with the new tools that we have, is there a way we could streamline so we might maybe know how many acres were planted, I don't know, before it's harvested?
So this is a huge topic of conversation at the department these days. And while I do not work for NASS, I work with NASS closely, so I can't speak on their behalf. I want to make that very clear. But we are working on how to make sure that the information that we are receiving through FSA and RMA can be more easily translated. That's really being done in the as a part of the One Farmer, One File initiative that was announced several months ago by the Secretary. And acreage reporting modernization at the Farm Service Agency is the first step in this. We are very excited about the progress that is being made in acreage reporting and the ability to be able to get data sooner than we have been. Hopefully in the next couple of months, we will be rolling out, we've been doing a pilot for the last few months, and we hope to roll out to the entire country our new acreage reporting system, which will hopefully allow producers to be able to, instead of, if you plant corn in March, but you don't report it until July, that doesn't help a lot of people in trying to figure out what's out there. So we're hoping that some of the technology we use will be able to generate some of this information sooner. So I can't get into the details much further than that, but it is something that we are working on very hard at the department and is a huge priority for Undersecretary Fordyce.
If I may, just to follow up.
Please.
I applaud that initiative. I was not aware of it. That will be a help.
Yes.
Thank you.
Thank you.
Do we have anybody on the phone? Please.
Hey, Robbie Boone with the Farm Credit Council on behalf of the membership of the Farm Credit System. I just want to say thanks. First of all, thanks to the Commission, for Emma, for all the work and pulling this today together. Really important. Particularly important in this topic in terms of risk management tools for farmers and ranchers. The Farm Credit System, as many of you know, represents about 45% of the ag lending in the United States, about $460 billion in gross loans. we could not do, the U.S. farmers and ranchers in this country could not do what they do without the certainly the crop insurance program itself, and particularly the comments that John Newton made. First and foremost, the crop insurance program is hugely important for those particular producers, particularly for new farmers that are starting out. Really, really difficult to just get started, and sometimes they don't have the history, to production history, to sometimes qualify for some of those programs. So it's really important. I want to compliment Heather Manzano in particular. The program has come certainly a long way, and certainly my 2 decades in Washington, D.C. in terms of the flexibility of the program, certainly the new product offerings. But as the comments have already that have been suggested today, sometimes it's not necessarily more product offerings that are needed. It's just more sort of improvements to what we've already got. And in terms of other, using the derivatives markets, again, that is a tool in the toolkit, but as others have suggested, certainly for a lot of our membership, and I would imagine for friends in the commercial banking space as well, the crop insurance program is going to be sort of the first and foremost tool. So again, appreciate the attention on this agenda today to risk management tools for agricultural producers, and appreciate the time.
Thank you. Ryan?
Thank you very much, Chairman Seelig. Good to see you again. Really enjoyed you coming down to Florida and looking at operations with Emma and your crew, Amir. Thanks to USDA and for the panelists that commented today. I'm the incoming chairman of the American Sugar Alliance, but my day job is running the Florida Sugarcane League. And it was noted, these are great products, right? I mean, we've got good contracts listed on exchanges. We're looking at possibly new markets, new ways to trade and hedge. But specialty crops are always a problem. And I say that with all due respect to everybody that develops all these products. We don't have 90 million acres. We've got a couple of million acres, and we've got 2 different crops. We've got beets and we've got cane. And then you've got to process these things. And nothing can move as fast as what's going on a daily basis, really, in the market. And obviously, if you lose something very early in the year, you've lost everything if you can't recoup something on that. That's horrible. Nobody ever wants that. Everybody wants to have a product get to the end of the day to sell. Then maybe if there's a loss there, whether it's pest, weather, whatever, you get some help. Whether that's a crop insurance contract, whether it's a disaster aid that Congress or USDA comes through with. But I'll just say we've got a lot of work to do. We know that, and people have worked on this for years. And I'd echo, Robbie and Kate and Dr. Newton had all said, people have worked on this stuff hard. There's always room for improvement. So we look forward to working with you. We've got a new invasive pest that we're dealing with in Florida and Louisiana that just came out of nowhere, like nothing we've ever seen. The beet industry is dealing with a kind of a perennial pest that they deal with off and on. But we want to thank you because you have reconstituted the committee. We're meeting. We appreciate that you're getting other agencies involved so that there's some symbiotic relationships there, because most of these things are a multiple attack for a farmer. You have to have good crop insurance, you're hedging in the markets, and you're, dealing with your daily business of trying to get by. And even for the most advanced farmer, you're always learning something. There's always something better. So I just wanted to say thank you. Thanks for spending the time on it. Thanks for getting out and seeing people around the country. Appreciate it very much.
Thanks, Ryan. Gabe.
Thank you. Gabe Effline with Cargill. So maybe my question's a little bit more forward-looking for Mary Catherine and for Heather. So firstly, thank you for giving us a breakdown of your segments. And where I think about forward-looking is that the Trump administration has just ushered in the most pro-growth, pro-farmer biofuel legislation since its inception, and that provides a massive injection of opportunity as we look forward, and certainly as we're prospectively looking forward to the Set 3 segment of the biofuel policy coming forth, which optimistically provides more stability and a more robust platform for continued growth. I think about that through the lens of the complex task you have to create insurance products that allow the farmers to have confidence in planting new crops. And you think about the opportunity for farmers to grow in areas linked to biofuel of the future, intermediate oilseeds, novel oilseeds, things like that, that complement, or maybe even cover crops, things that complement their existing crop profile, enhance soil health, things like that. Do you believe that the current setup needs to be, I guess, simplified or augmented in a way that enables that growth so that farmers can connect to those future markets in a way that's swift and accretive to them in the years to follow?
I would say that in any insurance commodity that we're talking about, access to those future markets is always critical. We are required to be actuarially sound by law, and having access to those expected prices in the futures market enables us to do that in a way that's transparent and, again, actuarially sound. So it's critical. We are trying to make progress as much as possible in the oilseed arena. We have a couple of products that we have approved that are along that route. Data is always a challenge for us, but it's core to our program. So as we are able to get additional data, we have every intention of continuing to grow in those areas.
I don't see any other questions, so I'm going to take this as an opportunity to ask a question, first of our presenters and then of the AAC members at large, that ties in this conversation with our next panel. Is there an opportunity for event contracts on prediction market platforms to fill some of these risk management gaps and allow producers to hedge risk? Weather, yield, diseases. Anybody want to take that from our panelists? Derek, please.
I felt like that was reserved for one person maybe, but I'll take a shot at that. Ed, you raised a good question. I think that we're always talking to our customers about unmet risk management needs, gaps in how to manage risk. We're constantly talking to customers about where and how we can fill those in, whether directly in futures and options markets or cleared products, any other efficiencies we can bring to price discovery. We have spoken to a lot of folks about the need on the very points you've raised. Cattle on feed is one that we've heard a lot of. Acreage we've heard a lot about. Yield we've heard a lot about. So we're talking to many folks in this room and on the probably folks listening to this today about what kind of product would suit that need, what hours would suit that need alongside the underlying markets themselves, and who would be the natural participants in those markets. If they suit their needs and if they solve a legitimate risk management need, those are the conversations we're having right now. So nothing to discuss beyond that, but like many of us in the room, we're constantly talking to customers about how we can help them manage their risk.
Derek, I appreciate your comments, and it really wasn't just directed at you. I'm going to make a comment from my seat as an AAC member. I'm Ed Prosser. I represent the Schooler Company. But a lot of times, I think agriculture looks at something that's new, and we are too quick to say, well, that's not how we do it. And I do think that there are some of these innovations in the ag space that have some merit. I would suggest the old Iowa and USDA corn yield contract that we had. This would have been in the 90s. That was an event contract. We didn't know what to call it then. We used USDA data, the most unimpeachable fair referee in the world, to call the ball on a settlement of a contract. So I don't know exactly, and I'm not proposing that there are any specific contracts that we should have that we don't have, But I am suggesting that maybe this platform is useful to fill some gaps that we don't see, that we don't have the opportunity today, cattle on feed. I hadn't heard that one. That's a good one. WADSI reports, but I do think there is an opportunity. I'd welcome anybody else's comments.
I think you hit the nail on the head, right? Which is there an objective reference point that says, yes, this happened, no, it does not happen, right? And I guess the challenge is, where do you find that objective reference point? So you talked about, in the contract that you described, so the USDA came out with that information. So, but then in the case of weather, somebody's got to come out with that information. So that's all. But, it'd be interesting to see whether people have been thinking about this.
Joe.
Again, Joe Barker, NCFC. I share your vision that there are innovations that could be used for risk management. I think one of the challenges will be the binary payout on an event contract. Because for agriculture, let's say you're hedging how many acres are going to be planted. Let's say you supply fertilizer, right? You want to hedge acres. You don't want to necessarily hedge price. The binary payout of an event contract limits the effectiveness of that hedge if there's a large difference between the expectation and the number that comes out. And so that variance can be a big deal. And so I would encourage some innovation there to maybe have a non-binary payout, whereas event contracts today, don't have that flexibility. But I share your view that some of these innovations can be useful tools.
Thank you, Joe. Chris on the phone, I think.
Hi, everyone. Chris Betts, representing Michigan agribusiness. My point would be that I question how much adoption these types of contracts would have. I think, Ed, you made a good point that gap exists and that there is a practical use of these contracts. But, as an effective risk management tool, I think those individual contracts would need to be well adopted. I would point to, CME's newer, small fertilizer contracts that, start to address this problem, but they've had some struggles to, really be adopted. And I think if you have a bunch of individual event contracts that are kind of tangential to each other, the industry might struggle, to adopt them and make them, an effective risk management tool.
John.
One thing I would point out is futures and options contracts have been studied by our land grant institutions for decades, teaching farmers how to use these tools, how to determine what their optimal hedge ratio needs to be. We've worked with farmers for years about, you have a physical interest in the commodity, you are in a natural short position. I think these event contracts create the potential for folks to take positions in the market that would run counter to them being a bona fide hedger. I think you could encourage speculative behavior in these markets. So I do think there needs to be a lot more research before these are just widely adopted as a risk management tool.
Thank you, John. Ryan.
Ryan Weston again, and American Sugar Alliance. I continue to think we're at one of the most interesting times we've ever been in with technology and agriculture and everything coming together, both on the production side and on the, the marketing, hedging, all of this. And kind of going back to where these smaller crops, and as was noted by the administrator, I think the crop insurance program baseline, when we did the policies updates in 2002, I think it was $1 billion a year. I think that was what the baseline was. So you look at the exponential growth of what happened. You look at the trading on the exchanges, how much that's changed. And I know there's a lot of innovation that's going to happen. and I know we need to do it correctly. I still look at these unique events that happen. What is the market? How do you do it safely? I'm going to show my age. Head to arrive contracts or what we were trying not to replicate and allow again. And we had all these other instances where things have happened through time, and regulators cannot always stay ahead of what's happening in the markets. And the markets have done a great job with being SROs. So I know everyone, you want something that's got discipline, you want transparency, you want someone to be responsible. And so I think we're at this unique time where how does this happen? Because there's great opportunity to get things right. There's great opportunity to get things wrong. So that's why I appreciate these conversations, because, we're not going to stop more automation the way we grow our crops. That's going to happen. But we're also never going to be a 90 million acre crop in the United States like our corn friends. Like, we know that. So there's lots of avenues to get things right around here. And we have our ICE contract, right? It's one thing that's there. We're really appreciative of it, but we know we've got to look to the future. You're always looking for what's better, what are the other options out there. If we can't come to you with an idea, who do we go to? And so we appreciate it, appreciate the conversation.
Please.
Yeah. Just to add on, to what's been shared, no one wants to be, in agriculture, we shouldn't be against innovation just for innovation's sake. I mean, all of us have had to modernize. Agriculture has had to modernize maybe more than, particularly in the United States, anywhere else in the globe. But, maybe something for the commission to think about as it's thinking about these issues going forward is, what problem are we trying to solve? And certainly from our members' perspective, as lenders to U.S. farmers and ranchers, the standard should be: is it improving a producer's ability to manage an actual business exposure, not simply whether or not a new contract can be created.
Thank you. Oh, Neil, I'm sorry.
Neil Donovan, Ubungi again. I think that's a very good point. It seems that this could be a trend towards trying to get into binary outcomes and trade those numbers rather than maybe a price move that could be triggered by a report itself. We know because of market makeups or the variables, price discovery may not trend to what expected reports could eventually print. So ultimately, I think we need to question whether these tools actually provide the hedging mechanism for price risk to these producers, and invariably does it converge back into the physical markets to provide them with that protection.
Thank you, Neil. All right, I'm going to propose one more question. Again, to our panelists first, as a guest, and then to the rest of the committee. Are there education gaps that need to be addressed for producers to better understand what risk management tools are available to them? Whether that is for the USDA product offerings or hedging risks through the derivatives markets? Are educational resources available for futures and options markets equally accessible to all regions and all types of producers? Kate.
Yeah, I would say that there definitely are some education gaps just in terms of product offerings, making sure producers understand, how to use those products, where do they go to find them. I think one of the things I mentioned earlier through kind of our LRP task force that we've been working on the last few months within our organization, that was an area that they really wanted to focus on, and something we're going to work on moving forward is how can we better arm our producers with these products, and how can we, whether it be webinars or working on different you know, tools, things like that. How can we better, you know, educate our members on all of the many products that there are available. So definitely something we're thinking about and wanting to work on in the future.
Thank you, Kate. Please, John.
I'll speak on the livestock side first. One of the things that I think helped livestock producers is when we were building the dairy policy, we got a lot of outreach from commodity brokers that wanted to become trained and licensed insurance agents in order to sell the crop insurance product. And then when they would meet with a farmer, not only were they there to talk about the crop insurance offering that they had, but they could also talk about the other risk management tools that the brokerage firm offered to producers. So it helped bridge the gap. I think there is a difference in the crop space because crop insurance agents are not commodity brokers. They're not traders in Chicago. So you're not bringing those tools in the toolbox to the grower at the same time the way they are in the livestock space. So I do think there, you know, needs to be continued educational opportunities. You know, whether it's changes that were made in the One Big Beautiful Bill for Farm Bill, ARC and PLC programs, whether, as Ms. Manzano mentioned, you only have 25% of the milk supply that's covered under DRP, where there's 75% sitting out there that may not know or know how to access the plan of insurance. And then I think there, as I mentioned in my earlier remarks, providing the right incentive tools to get agents to deliver these policies to smaller farms. A lot of agents, crop insurance agents, their commission is based on the premium. And the premium for a 10,000 cow dairy operation looks a lot different than the premium for a 50 cow mom and pop dairy operation in New York. And how are we bridging that gap, both from availability and then education on how these tools work?
Derek.
Derek Salmon, CME Group. I think, Ed, you make a good point. I don't think you can ever do enough education and training. I think markets continue to evolve. Risk continues to evolve. This market continues to globalize. And I think that there's a number of ways in which many of us around this table are already partnering to get training, education out into the hands of the end users. We don't touch many of the end users directly ourselves. We go through intermediaries, we're the clearing firms. FCMs, particularly the non-bank FCMs that service a lot of this community, is hugely important for us to continue to partner with. We do work with state fairs, 4-H clubs, any way that we can get down to grassroots levels, just to explain how markets work and what's available, whether they are directly engaging in futures markets. They're still setting the price for crops, and they're still setting the price for livestock. So understanding how those markets operate and learning about that is something we spend a lot of time doing. We can't do it without the partnership of the folks in this room and the folks of the customers that are serviced by the people in this room. So we're open to anyone that would like to work with us to get the word out on how markets operate. We think that only leads to better outcomes for everybody.
Thanks, Derek. Brandon?
Yes, hello. Glad you guys brought up the education piece. I'm representing the American Soybean Association. I farm here in eastern South Dakota. And this education piece was a real sticking point for me for several years when I first came back to the farm. I studied engineering, so I didn't really have a background in, you know, I grew up on the farm, but I didn't have a background in these financial tools that we use, some of the things we're here to talk about today. And I had to really actively seek it out, and it kind of frustrated me how many years it took me to find like a college classroom style education where somebody's just going to teach me what a call is and things like that. They're really basic stuff. When our bank, for instance, will bring in a market speaker, they really just want to talk about current, like that marketing year. What are the trends? What's the crop size and the things affecting price right now? They don't zoom out and educate. And so I'm really glad I ultimately found what I was looking for, but I do, as a producer, want to comment. Very difficult and really something you have to seek out if you want to learn about this stuff.
Thanks, Brandon. Brian?
I kind of wanted to follow up on that with that East River farmer there in South Dakota. those are the things we find too. Your interplay, you take a crop, like we don't have it, but the ARC PLC, that's certain coverage you have depending on which of those you choose. And then your crop insurance on top of that. And then do you have something else layered in there? It quickly becomes pretty daunting if it's not something you grew up doing or knowing. And I've never seen a farm bill or a hearing on risk management where you don't talk about the education side. And it is difficult. I mean, we've been talking about it for the 30 years I've been here. So I really appreciate the question. I think it's very important. And I've never seen something simple. I will say we finally had a trigger crop insurance program on weather. You know, you hit hurricane wind speed, boom, that's there. Fairly simple. You don't have to wait and come back and bring a crop insurance adjuster out there and keep a strip of something for X days past. And so you do have this innate ability sometimes to create a very simple product that people can understand. But as you start getting a USDA program wrapped in with that, maybe with some other underlying base program, MPCI, the interplay gets to be very tricky. So I will say, I think that's a great question, and we can never do enough.
Hi. Oh, I'm sorry. Please.
I was just going to add, I agree with a lot of the comments that have been made. I think there's always an opportunity for education. We have, the Risk Management Agency has 10 regional offices located throughout the country. They do extensive outreach with different groups, stakeholders, commodity groups throughout their regions. But to the extent that we need to partner more with them, we are always interested in doing that. The other piece, I guess, is that we do rely very heavily on the insurance companies as well as the agents to do a lot of that direct outreach. But if that is not the experience that farmers are having, we need to know that, because we can make sure that we connect producers who may be smaller or may feel like, I'm not really getting much response, or is the product really right for me? We can put them in touch with the right people to have that conversation. So please don't hesitate to let us know that.
Mary Catherine?
I would agree with several others to say you can never do enough education on these programs. They are evolving, and the challenges that producers are facing are evolving. So just FSA in particular is looking to improve how we get information to producers about these different programs. So want to extend the offer to any of our partners here in the room. If there's anything that we can provide where y'all can help us get the message out about the programs that we have, especially to some of those producers that may not be doing business with FSA right now that should be, that aren't aware of some of the opportunities that we have. We always welcome the opportunity to host webinars or do other outreach events because we do realize that a lot of our programs can be complicated. Internally, we are also looking at developing some interactive tools to help producers make decisions or be able to figure out quickly if they're eligible for a program or not, as well as continuing to educate our staff in the over 2,100 offices across the country that we do have. We do host trainings on a regular basis for them, but we do know that our staff have a lot on their plate right now, and we do rely on a lot of our external partners to help educate your members or other producers about the offerings that we have. So open invitation to partner with any of our organizations who work directly with producers. But
Thank you. Matt?
Yeah, just a quick comment to Heather and John. I think you mentioned it too. Some of the best education, at least in my experience or our area, is through crop insurance agents. They tend to dig into these policies, get a real understanding for what they can do with risk management, and they've already developed some of these relationships and trust with farmers already. So I think that's a pretty good path to go down to further educate our industry on it. So I've seen that as the most effective way so far, or an important way of doing it. So just for future use.
Thanks, Matt. With that, some comments from our sponsor.
Well, thank you, Heather, Mary Catherine, Matt, Kate, and John. Really important discussion. These programs are essential to farmers and ranchers throughout the country, and so I want to commend all of the work being done to make sure they're available. our derivatives markets are ever evolving and offer a wide range of products, but they don't offer risk management in every commodity, nor do many of these programs. And of course, farmers and ranchers are not able to access a lot of the products in our markets due, in part, to really this over-regulation that began many, many years ago, but really got a lot worse during Dodd-Frank and the implementation that went through, and as I said in my opening remarks, pushed out about 80 different rules and regulations in a couple years. So we really need to right-size that, make sure that we're doing everything to increase access to these markets, because even if, to Dr. Newton's point, many of the farmers and ranchers aren't using these products, and in large part probably because of the over-regulation, they're being impacted by them. These products are the products that are pricing the risk management, the crop insurance that they're using, and they're also affecting the crops they're trying to bring to market. So we really need to make sure that we're doing everything to get this regulation right, because it's absolutely essential. That's why Emma and I, early into my tenure back in March, sat down with Secretary Rollins and her team to make sure that we're looking at and identifying the types of crops and products out there that don't have a risk management tool, whether there's no crop insurance, no futures market, nothing else. And that's why I do think some of this conversation around new types of derivatives, new markets is important. It's not so much a question of what product we should be using for risk management, but just the fact that there should be risk management tools available for this wide range of products. We need to make sure that we're fostering competition, that we're allowing for these markets to develop, because they're absolutely essential. So I appreciate everyone's comments today. I think this was a terrific discussion, and would look forward to continuing that in the years to come.
Thank you, Chairman. We're now going to take a 15-minute break. There's refreshments in the back of the room. Let's plan on being back in our seats at 3:05. Thanks. See if we can get back together.
I know. Hey, can everyone take their seats, please? Thank you.
I don't see Liam, so we can't start without him. All right, welcome back. We are ready to explore our last topic of the day, 24/7 trading and emerging markets. One of our AAC members, Mr. Liam Smith, who represents PTG, will present on perpetuals.
Thanks a lot, Ed. Appreciate that. And I think this presentation is certainly in the vein that we all just talked about in terms of furthering education and deeper understanding of this product and some of the innovations we're seeing in the marketplace. So I'll start here. Good afternoon, Mr. Chairman, Commission staff, and members of the Agricultural Advisory Committee. Thank you for the opportunity to speak with you today. My name is Liam Smith. I'm the Chief Strategy Officer at Optiver. I'm speaking today on behalf of the Principal Traders Group, otherwise known as PTG. By way of background, PTG is an association of principal trading firms that trade their own capital in derivatives, securities, and digital assets worldwide. As a group, our members are key providers of liquidity, market depth, and price discovery across global commodities and financial markets. At Optiver, we've been making markets and managing risk across global derivatives for 40 years. Our role as a market maker is simple. We quote continuous two-sided prices so that commercial hedgers, institutional investors, and end users can transfer risk efficiently whenever they need to. I'm joining you today to discuss a derivative structure that has seen notable growth across global markets, perpetual futures. Our goal for this session is strictly educational. As financial innovation moves into new asset classes, our objective is to break down how these products work under the hood, demystify the mechanics, and provide a clear, practical foundation so you can form your own conclusion about their place in the derivative landscape. For market participants, perpetual futures can offer real structural efficiencies, and at the same time, they introduce unique market dynamics around continuous margin management, 24/7 trading cycles, funding rate volatility that requires really thoughtful evaluation. We aren't here to advocate for a specific outcome. Rather, we want to walk through these mechanics step by step, how funding functions, how liquidity behaves, and how risk is managed in practice. Thank you again for the invitation, and I look forward to the questions at the end so we can continue the discussion. And thanks, Emma, for hopping along there. So real quick, before we even jump into what is perpetual futures, I think we really wanted to start with hitting on some key terms, talking about the contract structure, and then obviously really focusing in on what I'll call the index and then the funding rates. And I think that's where we really want to spend a lot of time with everyone and make sure you walk away understanding what that is and how it functions and how it works. I think we do want to touch on some of the other features that kind of come along with this product, including the auto liquidation. And obviously just discuss some of the features where you do hear a lot about 24/7. I think this is all important information for this group holistically, and I think we're very open to making sure you have a deep understanding of the product. So as you can see here on the first slide, I don't want to read it line for line, but as you can see, exactly what is a perpetual future? It's a derivative contract with no expiration. And I think a lot of people ask about what does that happen? Effectively, everything gets cash settled, in terms of getting in and out of that position. It's something that's actually been around for the 90s. I think the big thing to understand, Yale professor Robert Shiller came up with it as more of a way to measure illiquid assets back then. And it's really found a market fit in today's market, especially in digital assets, mainly in offshore venues. And I think that's another area we want to also spend some time about what's actually being happening onshore. When you hear that, we're talking about the U.S. versus offshore, which is non-regulated in the U.S. And so the big step here, and it's come up here, is in May of this year, the CFTC approved the first onshore U.S. perpetual future, starting in Bitcoin. And I think the big thing here is also this group understands convergence, and it's an important part of the marketplace. And what we keep kind of talking about is this funding rate. And I'll use something Matt Cashman had said to me about where is the, people are saying, oh, there's no more risk because there's no more convergence. I think it's key to understand the risk has moved into the funding rate. And that's what you need to understand in terms of that, the market structure and the fit and the construction of the product. And so that's what kind of replaces that convergence in the market structure. So if we can move to the next slide, please. Just going to touch on a few terms to make sure we're all speaking the same language. Starting with the index price, I think what we want to say there is that's effectively often a benchmark in the digital asset space that's often used by referencing a number of spot markets in terms of how it comes up with the index price that the perpetual future will reference. I think that it's something to be noted. I think you'll see a lot of this as digital asset. The market is moving forward. I want to be on it, like on top of the fact that there's also looking at some of the other assets. I think there's a gold perpetual that's currently being evaluated and filed. But so I think the thing here is this market that we're talking about on digital assets often is really looking at spot exchanges to come up with that index price and kind of uses a number of different smoothing techniques to come up with a price that represents the spot market in there. Kind of jumping then really to the most important piece on here is the funding rate. And I think it's important to understand that it's a periodic payment. In most of these products we see it's on an 8-hour cycle. So I think it's key to note that there's often 3 of them throughout a day's trading. And I certainly can highlight, obviously, as we talk about 24/7, that's where this becomes very important in terms of monitoring this. And the idea of the funding rate, it's not there to tell you the price of Bitcoin or direct you in the direction of Bitcoin. It's there, again, to play that role of keeping it in lockstep with what is the index price in terms of moving around in terms of that. And so it's key to note this is also not an exchange fee. This is a payment across when things trade above it, either a premium or a discount. In terms of that payment that going across of the funding rate, that's obviously longs go to shorts when it's at a premium and vice versa when there's a discount. I think moving to the next slide quickly. Again, what does it actually look like onshore here in the U.S. and kind of where does it seem familiar? Where does it start to diverge? So I think in terms of what we see today, crypto assets, certainly a discussion around what assets make sense next, asset classes that is. But you see it's facilitated through the traditional model, the FCM, the DCM, the DCO model, things that we're familiar with in the traditional futures market. Is there leverage available? Absolutely. You can see this is a snapshot of what the current leverage is on a number of the contracts that are available. Here, this is where does it start to diverge? The 24 hours trading, that's where you start to have a conversation around the trading hours. The funding mechanism, making sure people understand where that funding mechanism is, and then liquidation is another area where it has a nuance that we want to make sure people understand this. Moving to the next slide. And I think this is where we'll spend a bit of time. So as we said, right, these never expire in terms of that. And so when you go about this, and there's an example on the next slide, but effectively what we want to say here is when the index price is calculated, again, using multiple spot exchanges to come up with that price, is compared to the perpetual future. So that's what it's referencing back to. And then the measurement of that, of where that's trading, is it trading in step with it, or is it trading at a premium or a discount? And that's, again, where we want you to understand in terms of the future moves around that index price or it stays in lockstep. What happens then is, depending on where it goes in those periodic payment windows, is where the discussion happens on, again, if it's a premium, longs to shorts, vice versa for discounts, and that funding flow happens, again, between market participants, not to the exchange. And again, and then the theory is, with this, and I try to talk about it, I put it at the bottom, it's really the rubber band theory. The idea is the further thing the perpetual future moves in terms of either to a premium or discount, there's then an economic kind of incentive for somebody to come in and push that back into line with the index price. And so many of these groups that we've seen so far often have a cap on the 8 hours kind of window that we're talking about. It's often around 2%. I think so then people need to understand, again, that could be up to 6% in a 24-hour cycle. It could also be 0 in a 24-hour cycle. And so I think that as the things move around, the idea of this funding rate is to try to push things back to what we'll call fair value, which is the index price of the actual underlying exposure there on that piece. Heading to the next one, just to give a real quick explanation in terms of using some real numbers. I understand Bitcoin's not trading at 100,000. I think the thing here I would say is, so in one of the baseline examples here, you have Bitcoin, and the index price is currently saying it is valued at $100,000. If we were to open a long position effectively at 10,000 notional on that position in perpetual futures, effectively this would happen here. Heavy buying potentially could push the perpetual future into a premium structure. As you can see here, as I mentioned at the bottom, the Bitcoin perpetual is currently now at 101. The index price is still at 100, if that makes sense. What happens then at the end of a funding window that we were just talking about? As you can see, it's finished above there in a premium. There's a funding rate of 1%. The longs will pay the short. What does that actually mean in terms of an example of that $10,000 position? I would move $100 to the short. Again, that's not including, that's not an exchange fee, that's not a spread. That is just a funding example of where people need to understand of where the funding rate mechanics happen. As you can see, all the groups that kind of offer this certainly put out the math behind how they're doing it and determining the premium or discount, how often they observe the product and what their observation periods are, and then the average of the premiums. And I think, again, it's something, if these are products that somebody wants to look at, you should deeply understand how those are calculated and when they're calculated. Moving on to auto liquidation, I think, again, we want to kind of touch upon that. Though we reference the traditional model, FCM, DCM, DCO, I think here, again, we want to make sure people are understanding what does auto liquidation actually mean and what's that process. And I think that, you know, the Commission has certainly taken a conservative approach, which I think is a good move in terms of this, in terms of the leverage available and things like that. And the reason I say that is because in a very simple walkthrough of what happens, it's just like a traditional market. You have an initial margin, you have maintenance margin. And if you've opened a position, if that position moves against you and you reach that maintenance margin ratio effectively, what happens then in that process? All of your orders are immediately canceled. Any open orders, I should say, that you have there. The liquidation engine currently then will look to do a market order often to the market, not the last traded price, which I think, again, is important to note in terms of closing out the position. And then obviously always the question is, hey, if there's a residual loss, who pays? And I think the idea is that by managing it in a conservative method like that, we hopefully don't end up with anyone with a negative balance in their account is the goal of having that kind of market structure there. I think like anything else, if there was, they certainly follow the more traditional guarantee fund that you see that's a hallmark of U.S. market structure and the exchange structure there. I think going to the next slide, just to kind of give an example, because again, I think you hear a lot of different things and a lot of headlines. Again, we're just kind of spelling that out in the bottom line of what does this look like, you know, in terms of a DCO, default waterfall guarantee fund, in terms of standard structure, in terms of there. I think we're not looking to kind of focus too much, I would say, on the offshore venues that you see there across the board. But as you can see, it is a very different structure in terms of how they go about managing these auto liquidation feature. You'll also hear about auto deleveraging with the many of the offshore venues. Again, I highlight that as this a different feature from what we're seeing here currently in the U.S. offering. Moving to the next one, please. I think a quick comparison too in terms of what's the same product onshore versus offshore. And so you'll see, and when you see the things like a centralized exchange versus a decentralized exchange, I think it's important to note again, what do we have here in the U.S.? We've got a centralized exchange, again, that many of the groups here operate. Where is it maybe start to see a little bit different? You see leverage is very different offshore from what's currently offered onshore today, which is a meaningful number in difference there. When does this happen? We're certainly talking about an 8-hour cycle here in the U.S. today, but certainly other groups offshore run it even shorter or continuous. And then as you can see here really is like what product is currently offered in this. And you can see certainly that groups offshore today offer things outside of digital assets across FX, indices, gold, oil, and then even stocks at times. And I think today it's meaningfully to note it's crypto currently. I think that there's a meaningful conversation around what other assets make sense for the commission to hear, but certainly something that's in the near front here to figure out. Running to the summary slide on the end, please. Again, I think this is I know I went through it pretty quickly. I'm happy to talk to anyone also. I think the slides, we're happy to share the slides if anyone's interested in those. But I think the big thing is really understanding it's a new type of derivative contract. And I think that the big thing that we wanted you to walk away from is understanding the funding mechanism in terms of why is that so important, especially to the construction of a perpetual future. Really looking in terms of, again, why is it important? And obviously, approved today, what does it look like in the future? And I think, talking about, Ed's kind of started that conversation earlier of obviously what asset classes make sense. Is it filling gaps? And making sure that people understand what that product is, and is it providing the hedge or the exposure that you're looking for versus the traditional future is a worthwhile conversation. And with that, again, appreciate everyone making the time. Hopefully, was able to impart a little bit of understanding in the product, and again, very happy to discuss it further.
Thanks, Liam. That's the third time I've heard that presentation, and I think I understand a third of it. So I've only got 6 more times, and we're going to be good to go. It is difficult. I'd like to open the floor to questions and comments from the AAC members on either perpetuals, 24/7, or emerging markets generally. What I'd like you to ask us, though, is to consciously narrow our discussion around agriculture. That's what we're here to advise the chairman on, because I'm really afraid we could get into areas that will consume a lot of time and be out of scope. So if you would, please keep your comments to remain on agriculture. As a reminder, the committee members participating virtually, please raise your hand feature. Members here, turn your cards vertically. Tommy, let's start with you.
Thank you, Committee Chair Prosser, and my name's Tommy Hayden. I'm pleased to represent the Commodity Markets Council. We're a trade association comprised of commodity futures exchanges, FCMs, and other market participants. And thank you, Liam, for that. Similar to Ed, I think that's the 4th time I've heard that, and I have a better understanding each time. So anyway, Chairman Seelig, I certainly appreciate the fact that you've acknowledged many times that not all markets are the same. And this really is, to me, a potential slippery slope. And I think when you really look at it, the true underlying purpose of the, Commodity Exchange Act are, one, price discovery. I mean, I think the fact that futures prices reflect the true supply and demand. And then two, really risk management, that it's a risk management tool. And what concerns me is when you look at traditional ag markets, as you focused on, Ed, it's really, I think they derive the utility from three things primarily. One is contract expiration, which, the perps that don't have an expiry. With that, physical delivery, and then ultimately convergence. And so, to me, I think that's where we risk having that. And when I look at the way this funding rate would somehow tie into that, particularly when you look at the spreads between your contract months. And because those spreads send very important signals to producers and end users. And, I just can't imagine a scenario whereby this funding rate of a perpetual could factor in, how they could or would factor in those ultimate spreads, which at the end of the day, if they don't, I think that just negatively impacts convergence and that hurts, I think, the markets in general. So not a question, just a comment.
Thanks, Tommy.
Thanks, Ed. Ananda Radhakrishnan, ABA. First of all, I think a question, and then secondly, I'm kind of confused. Liam, does the funding rate mechanism take the place of daily mark-to-markets and settlements?
No, I wouldn't say it takes place of that daily margining that you're referencing to. There's still, that's where I guess we're trying to say that's a funding cost, right? So it does not take the place of.
So there will be a daily at least once a day mark-to-market. The second thing I'm confused about is if the futures price is above the index price, the long pays the short. And this is in contrast to what happens now, right? In daily mark-to-market, if the futures price goes up, the short pays the long. So I don't understand that whole construct.
No, you're still right on that, right? Like in that example I gave, we're in the money on the position, right? I went long and the contract moved into a stronger position there. So you are correct on that. There is money transferred into the account. I think I was focusing on the funding rate, and I think, you come from a banking background, right? You come from where I think, SOFR plus 50 bips or however that funding works across 365. And I think that's what we're trying to explain to people is this is that new mechanism about your funding. And again, it's also something to be mindful of is you don't know where it will be. It could be in a premium, could be in a discount, could be no funding. And I think that's where we're trying to educate people to make sure they understand that. It's not guaranteed in terms of that funding.
Gabe.
Thank you, Liam. Great presentation. I think, what I will start with is a bit of a reaction, and I think it's been echoed certainly by the chairman, and really how are we adding value, adding utility to end users? And fundamentally, as an end user ourselves, as Cargill, we're serving as primarily as an intermediary to create and facilitate liquidity for our farmers end to end. And obviously we're part of an ecosystem that serves price transparency, mitigates unnecessary volatility in markets that allows investment signals, business planning signals to be sent efficiently. And I think about that in the context of our earlier segment, talking about the COT report and the changes there. This seems like an area that would be very difficult to understand and as constructed as described, and maybe my understanding isn't full yet, but how the various segments of that market might be tracked and help understand what is the market queuing off of, particularly in a 24/7 market that you're not sure what players, what actors are operating in that segment, particularly given the frequency of the settlement periods of price, as compared to what we have as a well-established physical commodity future that's well utilized across the Western Hemisphere and even to customers and traders in China that leverage these futures markets. So all that to say, my reaction is I'm not certain where this would add value as described. And again, if it's not adding value, maybe my other question is, are we creating disruption? And does that disruption hamper the ultimate purpose of this market, which is to create clarity and utility for those who are engaged in the underlying products. Thank you.
Thanks, Gabe. Joe?
Thank you. My comments on this are in conjunction with not all markets are the same. I think it's important to remember for many of our agricultural markets, we produce one crop, and then we have to manage that supply chain throughout the year. And the economic signals that come from a carry market, like we have in corn today, which encourages producers or warehouses to store rather than to release those commodities onto the market, is very important. Whereas when you get to an inverted market, like we have in energy today, where the perception is the war in Iran will relax and the price will come down, farmers that are going to harvest this fall don't want to pay the current price for diesel fuel. So they want to take advantage of the lower price that they can contract for to be delivered in October. This seasonality and these signals that these different delivery months and the convergence that comes with that is how we manage our supply chain in this country, specifically for commodities that we generally grow in one season and then need to ration out that supply over the course of a calendar.
Thanks, Joe. Nelson?
Thanks. Nelson Nill, Futures Industry Association. Thank you for the presentation, Liam. That was my first go-around, so I'm still trying to get my arms around it as well. But, you know, I think to follow on some of the other remarks, we want to make sure that we don't have a solution in search of a problem. I think we need to be mindful of that as we move forward. Specific to ag, I'm not sure there's any other commodity market, and maybe the folks around the table will correct me, where there's a greater connection between physical players and the original market structure of futures. If I think about commercial elevators, the minute that grain is procured from the farmer, a short position is set. And that short position is rolled depending on when they ultimately sell the product and move it down the value chain. One of the concerns I would have with perpetuals is ultimately liquidity. Would we have a situation where some of the liquidity could be drawn in a perpetuals contract in ag, and that may be a good thing, I'm not sure, when I think about hedge funds and other market participants. But does that ultimately leave those commercial hedgers and participants with less liquidity and further out contracts that ultimately disrupts what I think is a very, very fundamental mechanism into how U.S. agriculture is executed today? Thanks.
Sorry, Kurt. Thank you, Ed. Thank you, Chairman. Thank all of you for reconvening the group today. Kurt Struber, I represent the Grain and Feed Association of Illinois on the committee. And three things I wanted to tackle here. One of them is the 24/7 idea. It's easy in our industry to talk about our end users not being staffed 24 hours and therefore, don't want to have the risk of a commodity trading when they're not staffed. I think technology gets us around a lot of that, and I'm hearing less of an opposition to that concept, the 24 hours. The biggest issue, I would argue, is still the 7 versus 5 days. And it's not even an industry issue, because again, I think that technology could get us there to where we can manage risk over the weekend. What we can't do over the weekend is use the federal banking system. And so then we've got an extra 2-day margin situation over the weekend. It's a real challenge because it either increases costs dramatically if we have to extra margin on a Friday, or it increases liquidity risk, which is kind of my second point, the auto liquidity function that a lot of these exchanges have. And I don't know that they have to go down that road, but from a hedging perspective, auto liquidation is troubling. We're willing and able to meet margin as required, unless there's a serious issue, which is its own problem to deal with in a different way. But auto liquidation in lieu of margining is a real challenge from the hedging perspective. So that's a concern I want to make sure that we're cognizant of. And the final point kind of tags on to what you were saying, Nelson, in terms of potentially stripping out one segment of market participant if we offer a side-by-side perpetual futures against what I would call traditional futures. Craig Perrong, professor, University of Houston, a lot of you may be familiar with, just today, literally, had a blog post talking about perpetual futures. And I agree with his conclusion, which is exactly that one. He said there's kind of an unintended consequence if the retail trader, which is who perpetuals seem to be targeted towards, and I'm still an amateur, I'm not proclaiming that that's absolute, but that seems to be the target audience, and pulling that segment out of the traditional ag futures may or may not have a big effect, but any effect it does have is an unintended consequence, and again, segments out what's kind of a key participant in making good, liquid, and deep agricultural markets. So, thank you.
Please, Gabe.
Question for Liam. Just curious, with regard to the funding rate, how variable is it and how does that get reset over time? So and the reason for my question is there a possibility that the market can sustain a premium over the index for a period of time because the participants decide, you know, and I'm willing to absorb, you know, the settlement payment periodically because it's not punitive, so to speak?
Yeah, I mean, I guess the thing I would say is, right, again, we don't run one of these exchanges, and I appreciate the question, Gabe, but I guess like from what we've observed, again, as a market liquidity provider in this space is, you know, again, it is driven by the market mechanics. So to your point, could it happen where in those 3 8-hour cycles, it's at the maximum cap? Most of them have a cap at 2% per 8%. So like 2% per 8 hours, yeah, you could end up with paying 6%. That's a real outcome. Could also pay 0. So I think it's one of those things where we want people to, again, to your point, understand that and the funding mechanisms. I think it's fair to say it is a retail-driven product from what we've seen, again, on that side. And I think, you know, Nelson was giving me, apologizing for being a little critical. I think they didn't need to. I think we want to have a meaningful discussion here on understanding the product. What does it look like? How does it work? And so I think these are really good questions for us to understand those mechanics and what makes sense. And so to your point, is that a real outcome? That is a real outcome that could happen with this product.
I'd like to make a comment as a member of the committee. Schoolers, I think, and I have a relationship with a lot of people around the table, I don't think we're going to have much interest, at least now, in perpetuals in agriculture or in 24/7 in agriculture. But what keeps me up at night is how we're going to keep them out. Because I don't think there's any more interest around the table today than there was 6 weeks ago or 6 months ago. But they have already knocked at the door, and we're having trouble figuring out how to keep them out. I appreciate, Chairman Seelig, your conversations and your, when you talk about this, it's ag shouldn't be treated the same way. That we should be different. I just am worried that market forces on our exchanges and competition overseas, sometimes the right thing doesn't happen without our action. And if there's anybody have any comments for ways for us to make sure that we have a say as these things become available in other venues, or whether we get a shape the way they become available, I think that's an important part of this conversation. Derek?
Derek Salmon, CME Group. I think I would echo many of the concerns raised around this table as it relates to perps in ags. I think that question around risk management and the auto liquidation feature is one piece. I think there's even a more concerning piece, which is the auto deleveraging piece to that, such that if losses start to accumulate, you end up clipping winners and removing P&L and blowing longs when they're in the money, out of positions. Is a significant departure from standard risk management practices. I think as exchanges, again, we have 2 primary missions. It's price discovery and risk management. And if you're removing people out of positions when they need them and their most, that tells me that's a very different purpose and is a very different risk management practice than has underpinned the successful futures markets for these 170 years we've been doing this. I think when you also look at what a perpetual is versus what a future is, I'd highlight the comment that was made by Joe of the power of information in forward curves and what backwardation and contango tells you about expectations for prices of products in the future is absolutely crucial for end users when they're determining where and how to hedge their risks. That gives them pricing signals and allows them to manage their exposures to underlying positions. That doesn't exist in a perp market. A perp market is effectively a floating spot market that tells you the instantaneous price today. And I think that that's a very narrow use case for retail. You could make the case for applications to end users or physical players we have concerns about. So from a risk management point of view and from a product applicability point of view, we have concerns as to the applicability, since we're talking just about ags here, particularly to the physical ag market. I share a lot of the concerns of the folks around the table here.
Please.
Thanks, Ed. Ananda Radhakrishnan, ABA. Can I just respond to a point that Kurt made, which was, if you have 24/7 trading of ag futures, and the concern was, what do you do on Saturday and Sunday? Because I would imagine you'd have to have a mark-to-market on Saturday and have to have a market-to-market on Sunday. So then the question is, are the banks going to operate? And they could, but you got to pay them. Right? The other issue is FedWire doesn't work on, FedWire shuts on Friday. Right? So it's Monday to Friday, 22 hours, and that's how money moves between the banks. So potentially one solution could be, and I think Kurt, you were worried about this, you over-collateralize your position, right? Because potentially, if you don't want to move cash, the FCM has got to say, you got to pony up more margin because let's say you lost money on Saturday and you lose money on Sunday. I got to pay. You got to over-collateralize the position, and that's not going to be, I imagine, Kurt, not going to be a popular position that your members would take. So just a consideration. Thank you.
Your chance. Please, Jason.
Thank you. Jason Wheeler, USA Rice Federation. Appreciate the chairman for having us and everything. I completely echo what Joe, Kurt had to say. Huge points. I don't want to reiterate them, but definitely agree there. Just offered a perspective, I guess, from the rice business. When we went to overnight trading years ago, we're a small market, not a lot of liquidity in the rice futures, and which I know other people have that issue as well. And we talked about new markets and having them represented. One thing we saw when we went to overnight trading all night is, one, we're hunting liquidity. That's great, right? More hours, more liquidity. What we saw is that didn't really happen, but there were a few events, let's say, that hurt the people in the business, the people in agriculture using that futures market. And so in working with the CME group, they were very responsive with us and come to a conclusion. And we open at 7 o'clock Central and we close at 9 o'clock Central is how the rice contract works now. That allows those folks that have all the purchases in the afternoon as harvest is going on during business hours, but the market is not open. They're able to offset that risk, which is great, but they're not exposed while they're asleep for some weird thing to happen. So I guess, as we've said, you know, to do a blanket policy for agriculture for all the reasons stated and more, why that doesn't always apply perfectly to agriculture is true, but I would also say it doesn't always apply to every single thing in agriculture. So even if we get some sort of blanket policy, okay, this works good for agriculture in general, these smaller markets we're trying to develop, that may not be a great blanket even for those. So that would just with our history in the rice business, I thought that'd be a perspective I would share. Thank you.
Thank you. Neil.
Neil Donovan, Bungie. I would say not just rice, but even some of the more legacy products. You know, as we've expanded trading hours in the past, we don't necessarily see that as being volume additive to the trade. The liquidity just gets more extended through a broader amount of time. You still have very good liquidity and price discovery exercises in an opening bell before the closing. But throughout the session, you may still struggle to put large orders into the market. And you may have a slippage between bid and offer spreads there, which to me, adding more hours, especially into 24/7, would severely limit some of that ability to put these larger orders into the marketplace.
Thank you, Neil. Please, Ryan.
I just wanted to thank you, Ed, for working and being the chair of this august group, and I want to thank the chairman and his team for putting this together. Liam, that was a very helpful presentation for the neophytes like me. I'm a little nervous that there were a couple things I thought of, that this idea of just a spot market all day, going through the day and trying to understand how that interacts with basis when you've got a futures contract. I mean, this is a very good conversation, and I really appreciate it, because I think, you know, these are the things we're going to be asked by our members. How do these two things fit together? What are you doing about it? So I just wanted to say thanks. This was very helpful today.
I'm not sure if this is a question or just a comment, but Liam, thank you for your presentation. And, you know, you led off in terms of perpetuals, defining this as a derivatives contract with no expiration. And, you know, I guess using the, you know, get back to agriculture in a second here, but I guess using the example of Bitcoin, you know, someone could take the view that, okay, the price is going to appreciate, but a standard contract, you know, you're going to have a fixed date that would show like, okay, there's usually going to be price erosion as you get, or, you know, depending as you get closer to whatever that term is. So I guess the question is really for agriculture, you know, where is the transparency? Because as we understand it, or I understand just from what I've read, that the pricing can change. You know, there could be a margin call almost immediately depending on, I guess, specific to Bitcoin, what's happening there. Whereas for agriculture, you know, different things depending on the commodity, what's happening regionally across the, I mean, any number of events could be going on simultaneously or maybe just uniquely depending on what the commodity is. So again, just thinking in terms of what would be the utility for agriculture, there's just a lot of questions, it seems to me. Feel free to respond.
I think what I would point out there, it's a great question, I appreciate that, is what you're saying is right. We're using, and we're talking about Bitcoin, and we'll take the next step into agricultural product. And, you know, you guys know the cash markets better than we do, for sure. And I would say is like, there's maybe not always a available cash market to do the same type of pricing. So what we see in the offshore market, for some of those groups we reference, they tend to be referencing the front month of a more traditional future. So it's a derivative on a derivative. Again, this is what we see kind of offshore. And so why I think that's important to your point is because then it becomes a mechanism of just providing that spot exposure to the front month. And we've heard a lot about seasonality here. And I would say is like, that's not seasonality exposure you're getting, right? If you're trying to hedge energy in December, there's a seasonality component, and you're looking at this right now, and they'll say as we come into August, right? Like you're getting spot exposure today of what that price is, not the seasonality exposure in the traditional future. I think that's important for people to understand the utility of the product. I think that's a question for this group. Groups like ourselves, we can make markets in whatever needs to be made a market in. Really, at the end of the day, the end user, the commercial user, needs to see the value of the product and see that it fits into their tool belt for their hedging portfolio. And so that's where I think, again, that's why it's a question I think Ed's trying to draw out is, does it make sense? Do people see that value and things like that? And I think that's where the question is. I think it's a worthwhile discussion. Does it make sense?
Buddy Allen, American Cotton Shippers. I think I agree with everything I've heard on this topic. Cotton is non-fungible compared to corn and soybeans, and the way we commingle is very different. Our quality specifications are so granular, and we in agriculture enjoy really highly functional markets. Derek, Brad, thanks for your engagement with stakeholders like all of us around the table. We've built tools together that work really well. We're very particular about the physical delivery nature of the ICE No. 2 cotton contract. As Brad knows, we talk about it maybe weekly. And the fact that it's the gold standard for managing cotton risk around the world is powerful for the global competitiveness of the U.S. cotton industry. And the reason why the majors are here, the production is here, is related to that. And Ed, as you mentioned, I don't know how you keep influence from non-agricultural markets from spilling into and running parallel to traditional markets and having an impact on convergence and liquidity. And more time in our market would mean more time without liquidity, I think, rather than concentrating liquidity. So I've got concerns about outside influence, even if they're unintended. And I'm really proud of the functionality of our market, and we're careful in how we procure it and protect it. And there's nothing more important to our industry in the United States when we think about global competitiveness for U.S. agriculture. Thank you.
Thanks, buddy. Ethan?
Yes, Ethan Ongstead with Mike's Futures. So I would just reiterate Derek's comment. We've obviously canvassed our market participants. Demand is not there today. That can always change, but from what we've heard from our customers, there is not demand there to support this. Liam, great presentation. One thing, this is the second time I've heard it, which the first time I thought you brought up a good point on the derivative being a derivative, but specifically, have you noticed any liquidity issues with the perpetuals versus the spot? And maybe it's not a volume add, but maybe it's just shifting volume from the underlying index to the derivative, which would then make the underlying more volatile.
Thanks, Ethan. I think it's a little bit of a tough one because I'll reference, again, some of the products that we, again, I think it's a lot of the examples because this is such a new product. I have to go to offshore for giving you examples on that. And so I think effectively, like you've said, is if you look at the cash markets in Bitcoin today, the perpetual future is a magnitude now bigger than the actual underlying cash. And that happens in derivative markets. That's not anything new. But I would say is, it's certainly something where you want to be mindful of because at the end of the day, that derivative is still pointing back down to the cash market. So you want a really deep, strong cash market that's functioning correctly and really providing that the price discovery that we're all talking about, since that derivative market is significantly bigger, but at the end of the day, 100% reliant on the cash market. So, does it move? You've seen the cash markets, they're not maybe growing as fast as the derivative market, to your point, in terms of where people are putting down their exposure that we've seen so far from the offshore markets.
All right. Liam, I thank you for trying to help with a wildly complex and top-of-mind subject for the industry. This is going to be an ongoing conversation as we navigate this. With that, does the sponsor have any comments, please?
Yes, thank you, Liam. This was a fantastic presentation, and it's complicated stuff, so I really appreciate you breaking it down. And I've said since day one that we're not going to take a one-size-fits-all approach to any of these novel areas, whether it's 24/7 trading, perpetuals, or prediction markets. I always was disappointed when the regulator treated everything the same because the fact is, for so long, we've distinguished agricultural products in our statute and in our regulations, and I think we lost sight of that after Dodd-Frank with a lot of regulations that were just over heavy, really treated everything the same. We're not going to do that, but I think it's really important that we look at this novel type of derivative instrument and separate it from some of the red herrings out there where we're looking at what's happening offshore. We've seen many instances throughout the history of our markets where we've pushed things offshore. We actually had a ban on agricultural options, which many of you probably remember, and then we launched a pilot program when we got rid of that ban. And today we have all sorts of agricultural options in our markets, and they didn't take all of the liquidity out of the futures markets. But it's really important that we carefully look at each product, each underlier, and make sure that we don't force change for the sake of change or create markets where we're going to take liquidity out of our cash markets, out of our futures markets, because as I said at the outset, these markets are absolutely essential for risk management. And under my watch, we're not going to allow that liquidity to go move into products that really have no business, in our markets. But a lot of these novel contracts might, and I think we should think about that, whether it's for crypto or other areas, other types of financial instruments. It may work for those and not for agriculture. Maybe it does work out for agriculture. I mean, we're here to take this input and work with you all to make sure we get things right, and we're not, kind of centrally planning the entire market, because that's what you get in Russia. That's not what we want here in the United States. And that's why the United States has the most liquid and efficient markets. So this conversation is so important. I think it's probably one of the most important that we're going to have under my leadership here. And I'm really just so thrilled to have you all here at the table to help us make sure we get the rules right. But I want you all to think carefully about the contract itself. There's a lot of these red herrings of, auto deleveraging and auto liquidation. We don't have that today in our markets. We've never approved any sort of auto deleveraging or auto liquidation model. That's not to say we won't, but it has nothing to do with perpetuals. It's a type of clearing mechanism. We don't allow for the type of leverage that you see offshore that was demonstrated in the presentation. These products actually have less leverage than a lot of the products you'll find on some of the blue chip exchanges that are trading in our markets. So I think it's really important to separate fact from fiction. There's a lot of fake news out there. We're working to get this right, and we appreciate the partnership to make sure that we're separating out the wheat from the chaff and actually reaching a decision that's going to move our markets forward. So thank you all so much for this discussion.
Thank you, Chairman. Emma?
It is now time for closing remarks from Chairman Seelig.
Thank you, Emma. Before we conclude the meeting, I want to thank each of our AAC members for your thoughtful participation today. I thought this was a fantastic discussion. We covered a wide range of topics. I had some really excellent speakers here, such as Coach Tuberville and others from throughout the administration. Your expertise and perspective is so highly valued, and is really going to help us get the policy right. As I mentioned, this is such an important time, and Ryan said it a number of times today. I think this is one of the most consequential periods for our markets. We've got to make sure that we're not pushing innovation offshore, because what happened when they banned the options contracts, people went offshore and traded them, and there was a lot of fraud, and that's why we brought them back, actually, and they've worked out. And we're seeing the same thing with a lot of these novel products. We don't necessarily think they're appropriate for every asset class. I've said since day one, it's not one size fits all, but we've got to make sure that we're considering all these changes in our markets and not pushing things offshore when they might benefit farmers, ranchers, producers, others that are commercial users of our markets. I also, most importantly, want to acknowledge Emma, who's done such a fantastic job. She's my senior agriculture advisor. She's been really driving all of these efforts, not just for this committee, but our broader agriculture strategy. Believe it or not, I don't think there's ever been a senior agriculture advisor at the commission. We're really focused on making sure we get this policy right, and that commitment's demonstrated by all the terrific work Emma's done since she's joined the commission. We took her from Coach Tuberville, so he told me he was sorry to lose her, but we're really glad to have her. So while the formal meeting's now concluded, I just want to thank everyone, and I hope the AAC members will stick around for the next 30 minutes. We're going to have a small informal meeting, and I want to just thank everyone for being here today. It's really been an excellent discussion.
Thank you, Chairman Seelig. I want to thank everyone for attending this meeting. The official meeting has adjourned.